Good morning and welcome to the Public Service Commission of South Carolina. We are here for the continuation of the hearing in docket number 2022-89-G. That is the rate case with Piedmont Natural Gas Company Incorporated. Let's take a roll call of commissioners. Present virtually, we have Commissioner Irvin. Present in the hearing room, we have Commissioner Justin Williams, Vice Chair Powers, Commissioner Thomas, Commissioner Carrie Lee Williams, Commissioner Caston, and Chair Belser. Let's see, as we left yesterday, I believe we finished with a witness, and I believe our next witness from the Consumer Advocate. Is that correct?
That's correct.
Okay, Mr. Hawley. Well, any matters that we need to discuss before we begin?
Madam Chair, may I ask just a brief planning question quickly? I know today we've got Mr. Rothschild and then two additional company witnesses, the DCA Reserve Cross 4, and then two company settlement witnesses. Just for planning purposes, do you know at this point whether the commission has questions for any additional witnesses?
I have not heard that at this point, Mr. Huber. Thank you for asking. We don't have that, but if something arises, I will let y'all know as soon as possible. But at this point, we have none.
Thank you,
that
Madam
I'm
Chair.
aware of.
We'll work on preparing verifications.
Thank you. And that's a good point. Please remember to get verifications in for your stipulated witnesses. Those will need to be filed on DMS as well as provided a copy in here. Mr. Hall?
That's it. Ready for me to call my witness?
Yes, sir.
Thank you. Mr. Aaron Rothschild.
And I believe he's virtual?
No, ma'am.
No, he's live? Okay, thank you. Mr. Rothschild, let the court reporter swear you in, please.
Would you please raise your right hand? Do you solemnly swear that the testimony you'll give in this matter will be the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Good morning, Mr. Rothschild. Could you please state your full name and business address for the record, please?
Aaron Rothschild, 15 Lake Road in Ridgefield, Connecticut.
And by whom are you employed and in what capacity?
Rothschild Financial Consulting as president.
And how long has your company been in existence?
It's been now about 40 years. Forget the exact number.
And what type of services does your company provide?
We provide primarily rate of return consulting services in proceedings like this, also some accounting.
Mr. Hall, I know you're tall, but if you can get close to that mic, I have trouble hearing you, and I don't know what it's like out in TV land.
Sure. I will try. Thank you for letting
I
me
don't
know.
want you to be uncomfortable, but as far as leaning over, but if you can stay close, it is big help.
Okay,
Thank you.
I'll try. Mr. Rothschild, can you just provide the commission just a brief summary of your educational background?
I have a BA degree in mathematics from Clark University and an MBA from Vanderbilt University.
And similarly, a brief history of your past employment?
I performed financial analysis in the telecom industry in the United States and Asia Pacific from 1996 to 2001, and I worked as an investment banking consultant in New York for 2 years. I've been an affiliate of the New England Complex Systems Institute for 8 years, focusing on applying advanced modeling techniques to the power sector and capital markets.
And how long have you been preparing rate of return testimonies?
It's been a little over 20 years.
And you've appeared in South Carolina as well as other states, correct?
That's right.
And have you been accepted as a rate of return expert in all of those states?
Yes.
And Madam Chair, as previously stipulated and noted by the other parties, I would tender Mr. Rothschild as an expert in the capital structure, the cost of capital, and the financial analysis of regulated utilities. Mr. Rothschild, did you prepare 120
Mr. Hall, just a second. Please state the last one again.
Capital structure, the cost of capital, and the financial analysis of regulated utilities?
Okay, Mr. Rothschild will be accepted as an expert in those areas.
Mr. Rothschild, did you prepare 120 pages of direct testimony for this docket, which was filed on July 12th, 2022?
I did.
Did your direct testimony include 142 pages of exhibits labeled ALR1 through ALR6 and ALRA through ALRE?
Yes.
Madam Chair, for the record, the complete exhibits were filed as a revised version on July 22nd, 2022. Mr. Rothschild, did you also prepare 26 pages of surrebuttal testimony, which was filed on August 5th, 2022?
Yes.
Do you have any changes or corrections to your testimony?
I do not.
Madam Chair, I would move to have the pre-filed direct and surrebuttal testimonies of Mr. Rothschild entered in the record as if given orally from the stand.
Mr. Rothschild's direct pre-filed testimony and surrebuttal testimony will be entered into the record as if given orally from the stand.
And I would also move to have his exhibits ALR1 through ALR6 and ALRA through ALRE collectively entered as the next applicable hearing exhibits.
Mr. Rothschild's exhibits
It's a little confusing. ALR 1 through 6 and A
ALR
through E.
1 through 6. Weren't there appendices A and B also?
Oh, yeah, yes, ma'am. They were.
Is that correct?
To his direct testimony, that's right.
Okay, so appendices A and B and exhibits ALR 1 through ALR 6 and ALRA through ALRE. Is that correct?
Yes. And
Okay.
Sorry for the different designations there.
Okay, no, that's fine. Will be marked as hearing exhibit number 8 and entered into the record of this case.
Thank you. Madam Chair, I have some brief questions for Mr. Rothschild to answer in order to deliver a summary of his testimony. And just to note, I may use the overhead here a couple times during that summary. Mr. Rothschild, will you please summarize your recommendations for the commission?
Yes. My direct testimony provides my recommendations to the Public Service Commission of South Carolina regarding the appropriate cost of equity, capital structure, and overall cost of capital for Piedmont Natural Gas Company. In summary, I recommend the following cost of capital for Piedmont's gas operations: an overall cost of capital, or rate of return of 5.76%, from a range of 5.37 to 6.16%. 2, a cost of equity, or ROE, range of 6.98% to 8.74%, and a specific point of 7.86%. 3, a capital structure containing 44.58% common equity and 55.42% debt, which reflects the capital structure of my proxy group. And 4, a cost of debt of 4.08%. My capital structure recommendation is based on the average common equity ratios of the 6 companies in my proxy group. My 4.08% cost of debt is based on the company's actual cost of debt as requested by Piedmont. However, it would be reasonable for the Commission to authorize the common equity ratio with a 50% common equity ratio at this time if it would like to be extra conservative. To arrive at my recommendation, I applied the DCF, including a constant growth and non-constant growth method and a CAPM analysis to a proxy group of 6 regulated gas utility companies using data available through June 30th, 2022. Piedmont is requesting an overall rate of return of 7.26%, a return on equity of 9.9%, a capital structure containing 54.56% common equity and 45.44% debt, and a cost of debt of 4.08%. The company's rate of return request, if adopted, would require customers to pay about $11 million more annually than if my recommendation was used to set rates. Models are required to determine the cost of equity, like a map is required to plan a road trip. However, it is critical to remember that maps, like cost of equity models, are simplifications of reality, and it is critical to check our results against other known landmarks or financial facts. For example, we know that ComEd, a major electric utility serving consumers in Illinois, raised $750 million of first mortgage bonds in March 2022 with an authorized ROE of 7.36% and a capital structure with a 48.7% common equity ratio. Many utility company witnesses claim that ComEd's 7.36% ROE is not relevant because it is lower than the national average, or because it is based on a formula mechanism. However, 7.36% is 7.36% to investors, regardless of how it was calculated. The fact that ComEd is able to raise the capital it needs to provide safe and reliable service, despite having an ROE that is lower than the national average, is a strong indication that Piedmont would be able to raise the capital it needs if the Commission allows an authorized ROE for Piedmont of 7.86% or anywhere within my recommended range. ComEd's capacity to raise capital is just one of many financial landmarks I include in my testimony to show that my recommendations are reasonable. It is important the Commission understand that major financial institutions and pension funds that are collectively managing hundreds of billions of dollars are expecting a return on equity for the overall market that is lower than Piedmont's requested authorized ROE. As you can see in Table 4 on page 14 of my direct testimony, I think you'll...
Madam Chair, can you all see this on your screen? Thank you, sir. Can we show the overhead, please?
As you can see on this table that's on page 14 of my direct testimony, Horizon Actuarial Services survey of dozens of major funds showed a equity return expectations of 4.6% to 8.9%. And Charles Schwab published a 6.6% equity return expectation. And in June 2022, the source relied on by Mr. Baldino in his direct testimony, which is Kroll, published a cost of equity for the overall market of 9%. If the cost of equity for the overall market is 9%, the cost of equity for a regulated utility company is significantly less than 9%. Mr. Coyne's cost of equity recommendation of 9.9% and Mr. Bauer's capital structure recommendation, which is a 54.56% common equity ratio for Piedmont, are contradicted by so many financial landmarks that we know they are using broken maps. My recommended ROE of 6.98% to 8.74% for Piedmont makes sense. It fits financial reality. An ROE above 8.74% is nothing but a windfall for Piedmont's investors at the expense of South Carolina's consumers.
And Mr. Rothschild, how has Piedmont responded to your recommendations?
How has Piedmont responded? Piedmont's witness, Mr. Bauer, claims that if my 7.86% ROE recommendation is adopted, it would negatively impact Piedmont's ability to attract debt and equity capital on reasonable terms. Mr. Bauer, in his rebuttal testimony, reasons that since my recommended ROE is below the average authorized ROE of other natural gas companies, adopting my ROE, quote, would place Piedmont at a severe disadvantage in the competition for capital between natural gas distribution companies. A common misconception promoted by utility companies is that an authorized ROE must be consistent with authorized ROEs in other proceedings. The cost of equity should be based on current market conditions. Unless authorized ROEs are set based on investors' current expectations, as indicated by market data at the time of the proceeding, the resulting rates charged to consumers would either be too low to permit a utility to raise capital on reasonable terms or too high, such that ratepayers would be overcharged. By Mr. Bauer's logic, ComEd would have difficulty raising capital with a 7.36% ROE. But as discussed earlier, they have been able to raise hundreds of millions of dollars recently. Piedmont witness Coyne also claims that my 7.86% ROE is too low by comparing it to other authorized ROEs. He attempted to support his claim by fundamentally distracting us from the purpose of rate of return regulation. The purpose of rate of return regulation is to set the authorized ROE based on investors' expected return. and the return investors expect to receive is based on the market price of securities. Mr. Coyne states that the ROE is a market-based concept, but when applying his approaches, there are key places where he sharply deviates from this definition. For example, Mr. Coyne claims that Value Line's projected ROEs, expected accounting returns of 10.16%, indicates that my DCF results understates the cost of equity. Mr. Coyne is using an age-old trick by trying to confuse accounting returns and market-based returns. The 10.16% Mr. Coyne is referring to is the future expected return on book equity published by Value Line. In other words, this 10.16% is an accounting figure based on expected return on book value of equity, not investors' returns. An investment is made at the market price of a utility stock, not the accounting value. Therefore, Piedmont's authorized ROE should be based on the return investors expect on the market price of a utility stock of comparable risk. The average market price of the gas utility stocks in my proxy group is between 1.82 and 1.89 times book value. If investors are willing to pay between 1.82 and 1.89 times the book value of an expected 10.16% return on book value for gas utilities, they are expecting to earn a return significantly less than 10.16% on market. Therefore, it makes sense that my DCF market-based cost of equity is between 8.4 and 8.49%. In my opinion, Mr. Bauer and Mr. Coyne's testimonies fundamentally distort financial reality and should be disregarded.
Mr. Rothschild, do your recommendations comply with established case law?
Yes. If adopted, my recommendations would allow Piedmont to raise capital on reasonable terms while fulfilling their obligations to provide safe and reliable service. My recommendations satisfy the requirements of Hope and Bluefield that regulated utility companies should have an opportunity to earn a return commensurate with returns in other enterprises having corresponding risks.
How has today's financial market impacted the cost of equity?
In 2022, most equity investors had one of their worst first half of a year since 1970. The S&P 500 is down about 21% as of June 30th, 2022. In contrast, capital market data indicates that utility stocks in general, and even more so for gas utility stocks, have become significantly more attractive to investors in recent months. As shown on chart 1,
Can we have the overhead again, please? Thank you.
as shown on chart 1 on page 7 of my direct testimony, gas utility stocks have significantly outperformed the overall market since Piedmont's RSA adjustment in October 2021. As you can see here, since Piedmont's last RSA case in 2021, in October 2021, the gas utility stocks in Mr. Coyne's and my proxy group have increased over 25%, while the overall market is down over 13%. In the first 6 months of 2022, gas utility stocks are up over 10%, while the S&P 500 is down over 21%. Mr. Coyne stated in his direct testimony filed on April 1st, 2022, that utilities are expected to underperform the overall market. And, quote, if that is the case, the results of the DCF model would understate the forward-looking cost of equity. However, this expectation has not turned out to be accurate. He claimed that interest rates would continue to increase, and they have. Since he filed his testimony on April 1st, 2022, the market yield on 30-year U.S. Treasury bonds has increased from 2.44% to 3.14% as of June 30th, 2022, which is a 28% increase. However, his forecast regarding the impact of increasing interest rates on utility stocks was wrong. It is important to remember that capital markets are unpredictable. Therefore, the cost of equity should not be based on forecasts of the unforecastable. The cost of equity should be based on what we can measure, investors' current expectations. As shown on chart 5,
Overhead one more time, please. Thank you.
as shown on chart 5 on page 35 of my direct testimony, the interest rate forecasts used by Mr. Coyne are not always accurate. In fact, they have been persistently inaccurate. As discussed in my direct testimony, some of blue chip interest rate forecasts have turned out to be correct in recent months. However, it is not reasonable to trust the accuracy of blue chip's interest rate forecasts going forward just because of this one example. Interest rate forecasts are like a broken clock. Interest rates may or may not remain at historically low levels, but it is safe to say interest rates are unpredictable and consumers should not pay higher rates because some economists are willing to play astrology.
Mr. Rothschild, how did you calculate the cost of equity?
To arrive at my recommendation, I applied the discounted cash flow model, including a constant growth and non-constant growth method and a capital asset pricing model analysis to a proxy group of gas companies similar in risk, using data available through June 30th, 2022. My constant growth DCF model is used by major financial institutions. JP Morgan Chase uses the sustainable growth form of the DCF model, as I do in its 2019 long-term capital market assumptions publication. Principles of Corporate Finance, a leading financial textbook used in business schools and investment banks around the world, recommends using the very same method I use to calculate the cost of equity for regulated energy utility companies. As discussed in my direct testimony, my CAPM is based on methodologies used by the Chicago Board of Options Exchange and published in peer-reviewed academic journals. My sustainable growth form of the DCF model is more reliable than mechanically adding an analyst earnings per share growth rate to a dividend yield, as Mr. Coyne has done. The sustainable growth rate is more reliable because it maintains the mathematical relationship between earnings, dividends, book value, and stock price that must be respected. The non-constant growth form of the DCF model determines the return on investment expected by investors based on an estimate of each separate annual cash flow the investor expects to receive. The CAPM relates return and risk. Specifically, it relates the expected return on investment in a security to the risk of investing in that security. The riskier the investment, the greater the expected return, i.e. the cost of equity investors require to make that investment. The equity risk premium component of my CAPM is based on investor expectations as indicated by the price of stock options traded on the S&P 500. The betas that I use in my CAPM are superior to using betas based exclusively on historical data because the past may not represent current investor expectations.
And what are your concerns with Piedmont's and ORS witness Baldino's cost of equity calculations?
Mr. Coyne's 9.9% ROE recommendation is significantly higher than Piedmont's market-based cost of equity. If his recommendation is used to set rates, consumers will be significantly overcharged. Mr. Coyne and I have fundamentally different analytical approaches. I focused primarily on using market data, e.g. stock prices, bond yields, stock option prices, to measure investors' expectations as much as possible. On the other hand, Mr. Coyne relies considerably on historical data, e.g. betas in his CAPM are based on data from the past years, and non-market data, including historical accounting returns to inflate his results. Additionally, each of his cost of equity models has specific issues that contribute to his unreasonably high results. First, his constant growth DCF method is unreliable because it mechanically uses 5-year earnings per share growth rates as a proxy for growth without considering the mathematical relationship between retention rates, dividend payouts, and growth. A company cannot invest and grow with money it has paid out to investors as a dividend. Second, his CAPM methodology overstates the cost of equity by relying exclusively on 5-year historical betas that remain inflated because they are still impacted by the market turmoil during the early stages of the pandemic that are no longer representative of Piedmont's cost of equity. Third, his so-called expected earnings method should be disregarded because, as FERC concluded, it is not a market-based method. Mr. Baldino's overall recommendations are more reasonable than Mr. Coyne's, but are still inflated due to similar modeling issues, e.g. relying on 5-year historical betas in his CAPM and mechanically using analysts' earnings per share growth rates in his DCF model. However, some of Mr. Baldino's models do produce very reasonable results. He uses projected dividend growth as a growth component in one out of the 4 versions of his DCF model. Although in principle I do not agree with Mr. Baldino's use of dividend growth projections, in this case it produces a reasonable cost of equity result of 8.1% to 8.35%. The result of my constant growth DCF method is 8.4 to 8.49%. Therefore, I recommend that the Commission seriously consider the results of this version of Mr. Baldino's DCF model. I also recommend that the Commission seriously consider most of Mr. Baldino's CAPM results, using market risk premiums from respected sources like Kroll and Professor Damodaran. His cost of equity results are 7.8 to 8.08%, and the results of his historical CAPM results, consistent with the research findings he cites in his testimony, is 8.68%. Charging consumers above the current market rate for capital is not appropriate or necessary to assure capital is available and will result in an unjustified windfall to Piedmont. Mr. Coyne's 9.9% ROE and Mr. Baldino's 9.3% ROE recommendations are well above the equity return expectations of the financial industry, and most importantly, the equity return expectations of investors as indicated by market data. As I mentioned earlier, these cost of equity recommendations are also considerably above those allowed to utilities that have maintained investment-grade credit ratings and had no trouble raising hundreds of millions of dollars in capital. My cost of equity calculations show an appropriate ROE for Piedmont should be between 6.98 and 8.74%. Because I have often been asked to provide a specific number, I also include a point recommendation of 7.86%. Any ROE within my recommended range will satisfy the requirements of Hope and Bluefield that regulated utility companies should have the opportunity to earn a return commensurate with returns on investments in other enterprises having corresponding risks. My recommendations are consistent with legal standards set by the United States Supreme Court and market data.
Does that conclude your summary?
Yes, it does.
Madam Chair, Mr. Rothschild is available for questions from other parties in the commission.
Thank you, Mr. Hall. ORS?
No questions from ORS. Thank you.
I'm sorry, I forgot Mr. Elliott.
No questions, Madam Chair. Thank you.
Piedmont?
We have a few questions, Madam Chair.
Please go ahead.
I've got a couple of documents I would like to use with Mr. Rothschild, so with your permission,
Yes,
I'll use
yes,
that
sir.
podium. Thank you.
Wherever you're most comfortable.
Madam Chair, if I may ask Mr. Hall to turn that lavalier mic off. I'm sorry for approaching with that without notice, but I wish I had the problem where I had to bend down to speak into the microphone. I don't, but it really looked like your neck was hurting doing that. So if
Thank you. I
you
might need some instructions there.
just look at the top and at the top of that and off button. There you go.
Like Commissioner Hall, I am also not height challenged like or Commissioner Williams. I'm not height challenged like Mr. Hall is. So hopefully everyone will be able to hear me. Good morning, Mr. Rothschild.
Good morning.
I'd like to start off by addressing a couple issues that you raised in your summary. The first is you discussed expected returns in the market as a whole and in certain segments during your summary, correct?
Correct.
All right. And those expected returns were expected actual returns, correct?
Are the actual returns expected by investors?
Mm-hmm.
No, as more of like a cumulative probability.
Cumulative probability.
If an investor expects a return of 10% over a certain period of time, it doesn't mean they expect for sure they'll get 10%. There will be a probability of distribution surrounding that. And the expected cumulative probability would be 10%. That's what I'm talking about.
Right, so, but the 10% is a target, right? I mean, that's around the probability. If you pick a number, it's 10% in the example you just used.
We need for you to speak into that microphone, please. Thank you. I know you're trying to look at him, and that's fine, but just move the microphone to talk into it, please. And Mr. Jeffries, you may need to repeat that question. I apologize for the interruption.
Yeah, I'm trying to understand Mr. Rothschild's answer. I believe what his answer was is he said there were a likelihood of returns that may be possible around a particular expectation. And I think the example he was using was 10%. Is that right?
Yes, I would say it doesn't mean the investors expect necessarily it will be exactly 10, but in terms of a cumulative probability, you would say the 10% would be the expectation. Correct.
Right. And you've worked around regulated utilities for quite a few years, haven't you?
Yes.
And have you found in that experience that regulated utilities often do not achieve their allowed returns?
I have not done a comprehensive study on that. I have heard times when they have or have not.
And does sometimes regulatory lag play a role in how close they can come to achieving their allowed returns?
I have not done a study on regulatory lag, but I know regulatory lag exists. Sure. Yeah.
You don't know what effect regulatory lag has on the utility's ability to achieve its allowed return?
I have not done a specific study on the impact of that, no.
Isn't the inability to achieve your allowed return often the main driver in the filing of a rate case or a request for increased rates for public utilities?
Can you repeat the question?
Yes. You would agree with me that public utilities, either through general rate cases like this one or through alternative rate-making mechanisms, often come to their regulatory commissions and ask for increase in rates, correct?
Yes.
Okay. And isn't one of the main drivers of those requests the inability of the utility to earn their allowed returns?
That's one of the reasons I hear, or just because they believe the cost of equity has changed. I've also heard that.
Thank you. You mentioned financing by, I believe it was ComEd, of several $100 million of first mortgage debt as an indicator or evidence that Piedmont would be able to access the capital markets on reasonable terms. And you cite a relatively low allowed ROE for ComEd in that context. Is that correct?
That's correct.
Okay. Does the name first mortgage debt suggest to you that that debt was secured?
Yes.
Okay. To your knowledge, does Piedmont issue any secured long-term debt?
Not to my knowledge.
Thank you. You also spent some time in your summary discussing why your recommendations were right and why Mr. Baldino's and Mr. Coyne's recommendations were incorrect. You were here in the hearing room yesterday, right?
Yes.
And you would agree with me that Mr. Coyne, Mr. Baldino, and Mr. O'Donnell all testified yesterday that the methods that you used to arrive at your recommendation were, I believe some of the words were used, unconventional or problematic, correct?
I strongly disagree with all of
Understand.
those opinions.
Understand.
I'd
But
like to discuss that.
But you heard that testimony. Thank you. Okay. Your ranges and point-specific ROE recommendation in this case are based upon your analysis of Piedmont's projected cost of capital using several economic models, correct?
Mm-hmm.
And that analysis in your case consisted of 2 versions of discounted cash flow models and 8 variations of capital asset pricing models, is that right?
That's right.
And in running those models, you used a group of 6 comparable companies in your analysis, correct?
Yes.
All right. And you refer to those companies as the RFC Gas Proxy Group, and I'm assuming that stands for Rothschild Financial Consultants Proxy Group, is that right?
That's right.
And these are the same 6 companies that comprise Mr. Coyne's and Mr. Baldino's proxy groups. Is that
That's right.
And so, as I understand it, all 3 cost of capital witnesses in this case that engaged in economic analysis used proxy groups consisting of exclusively of gas distribution companies, right?
That's right.
Okay. And in fact, the same gas distribution companies.
The same.
Okay. Mr. Baldino and Mr. Coyne also used discounted cash flow models and capital asset pricing models as you did to evaluate Piedmont's cost of equity. Do you agree with that?
That's correct.
All right. And so we've got the same proxy group in this case. We've got 3 cost of capital witnesses. The 3 cost of capital witnesses are using the same or similar models, but we have very widely varying recommendations on Piedmont's cost of capital, don't we?
Not really, because many of Mr. Baldino's results were right in line with mine or even lower.
So in your mind, a 9.3 recommended cost of equity capital is the same as a 7.86 recommended cost of equity capital?
Did not say that.
Well, I thought I heard you.
Many of the results of his models are the same or lower than mine, is what I said.
Okay. Well, let's talk about the ranges that were produced by you and Mr. Coyne and Mr. Baldino. Would you agree with me that the varying results, and while there may be, I'll concede there may be some overlap between witnesses on
Considerable, yeah.
on some of your economic results, but the ranges in general that you all proposed to the commission are not overlapping for the most part, right?
No, quite overlapping with Mr. Baldino.
Okay. Is the variances in the model results that were produced by the 3 companies, are those due to variations in the inputs that the 3 of you used on your models?
Yes, there's some inputs that are a major contributor, yes.
Okay. And if I did the math right, your ROE recommendation, point recommendation is 144 basis points below Mr. Baldino, correct?
You're comparing the 9.3 to the 7.86?
Mm-hmm.
And or to the top end of my range, the 8.74.
No,
I wasn't sure.
the point estimates is what I'm focused on.
The point is not as opposed to the ranges.
Right.
Okay, I see.
And then that differential on your point estimates with Mr. Coyne is closer to 204 basis points, correct?
The 204 is between the point estimates?
Mm-hmm.
Yes.
All right, thank you. You read Mr. Coyne's testimony in this docket, obviously, right?
Yes.
And he testifies that your recommended ROE for Piedmont in this case is 84 basis points below any authorized ROE for any U.S. natural gas utility in at least the last 40 years, right?
I read that.
Okay. And he cites S&P Capital Regulatory Research Associates data for this conclusion, right?
Yes.
And you're familiar with S&P Capital RRA reports, right?
Yes.
Okay. And what they do is they monitor and report on allowed utility ROEs and capital structures.
Yes.
Okay. And you don't have any reason to dispute Mr. Coyne's observation, do you?
No.
All right. Does it concern you that your recommendation in this case, if it were adopted by this commission, would result in the lowest natural gas distribution allowed ROE in the United States in more than 40 years by a margin of 84 basis points?
No. We have authorized ROEs in the ranges that he gave with market-to-book ratios of gas utility companies close to 2. The math is very simple. The market-based cost of equity is considerably less than these authorized returns. It's standing right, the fact is standing right in front of us, lined up with many other facts that I give in my testimony, including why would the major pension funds and financial institutions in the world be expecting returns for the overall market that are less than these authorized returns? It's standing right in front of us that investors are not expecting a return that's equivalent to these authorized returns. I want to give one example that I thought. Imagine if instead of allowing returns for regulated utilities, it was for real estate, and we wanted to make sure that people were able to get affordable housing. And we said, someone said that the cost of equity for housing is 12%. So that would mean that if it was a $100,000 apartment, this commission would say, we're going to allow them to charge $1,000 a month for this apartment. We said, okay, that's a 12% return, $1,000 a month divided by 100,000. And what would happen then if we then put it out into the market and said, let's sell these apartments? The investors know they're going to be able to get this $1,000 a month. You would expect if the cost was about 12% or the authorized return, these apartments would tend to sell for about $100,000. What happens if they started trading for about $180,000? We would know that investors were demanding considerably less than 12%. The math is simple there. $12,000 over $100,000 is 12%, but $12,000 over the market price of $180,000 is significantly less. That's what we're looking at when we see these authorized returns.
So would you agree with me that the other three cost of capital witnesses in this case, well, the other two, Mr. Coyne and Mr. Baudino, do not see the facts as you do?
Yes, they do not. They do not see the facts, but it's more than that. I think that it's a misinterpretation of what we're trying to do here, which is to set the cost of equity or an authorized return based that's consistent with investors' required returns for risks of equivalent risk. No investor can go and earn those authorized returns. Impossible. Try to do it. Go to E-Trade and buy these stocks. You cannot earn those authorized returns because if you buy it, you have to buy these stocks at a multiple of book. Those authorized returns are being applied to book. If you want to buy those stocks, you have to buy at a multiple of book. You cannot earn those returns. No one can, because investors demand considerably less than those authorized returns.
And as I indicated, that position is disagreed with by the other two cost of capital experts that testified in this case.
I think what I'm saying is a fact. Those are facts. Go to your E-Trade account and earn those returns. Buy those stocks and earn those returns.
I believe the question I'm asking you is factual as well, but we'll move on. I'd like to talk to you for a minute about the use of discretion in conducting your economic analysis. Do you agree that the calculation of proposed allowed returns on equities involve discretion on the part of the expert conducting the analysis?
Can you give me a specific example?
Yeah, let's go through it. The first exercise of discretion, I believe, is in you have to make a choice about the selection of your proxy group, right?
Yeah.
I mean, we use 6 companies, natural gas distribution companies in this case, all experts did, but there are a whole lot more than 6 natural gas distribution utilities in the United States, correct?
Yeah, there's, I think, 10 followed by Value Line that we probably all
There's
started
only 10
with.
distribution company gas
Oh, it's more than
distribution?
10, but 10 is covered by Value Line, the group that we all started with.
Okay.
I'm agreeing, they're more than 6, yes.
Okay. So you make a decision about however many of those 10 you're going to use, right?
That's right.
Okay. And then you make a choice about which economic models you're going to use, right?
Yes.
And you used discounted cash flow, capital asset pricing models, right?
Yes.
But there are others.
I think I bet there are tens of thousands of models that are used by investors and more. Yeah.
But it's not uncommon for folks in your position to produce results based on expected earnings or risk premium models, for example, right?
Yes, the amount of models, there was probably as many traders or quants, there are as many models. But these are common ones that are used and can be helpful tools, yeah.
And then as we've already discussed, you have some discretion in choosing the inputs for those models, whether which growth rates or which are you using projected interest rates or in your case options related information. That's a choice you make as you're conducting this analysis, correct?
Yes.
Okay. And then ultimately, after you conduct your models and they produce their results, you look at them and you have to, as all expert, all three witnesses in this case did, you then make some judgment about what is your recommended range and your point recommendation from the data that's produced by those models, correct?
Yes.
Okay. And as far as you know, Mr. Baldino and Mr. Coyne followed a similar process, right, in their analysis?
I don't know how the process is.
Okay. But you do agree that the ranges, the recommended ranges and the point recommendations of the three witnesses are very different in this case?
Again, I just have to emphasize with Baldino, there's considerable overlap with our model results. Yeah.
Okay. But ultimately, the folks sitting up here on behind the bench are going to have to make a decision based on the evidence that's provided by the three cost of capital witnesses, correct?
Yes.
And in making that decision, they have some discretion, correct?
I think the commission has discretion, yeah.
Okay, thanks. They're not bound by any particular model result.
No.
The next I'd like to cover a little bit, I'd like to talk about the context of your recommendation. Are you familiar with Piedmont's current approved allowed ROE in South Carolina?
Yes, I haven't focused on it recently. I have heard, yes.
Okay. Would you accept that it's 9.8%?
Yeah, that was my understanding.
And that it was approved in Piedmont's 2021 Rate Stabilization Act proceeding about a year ago?
In October?
Yeah, it was,
Yeah.
I mean, the actual result was in October, correct? And that 9.8, that's 10 basis points below Mr. Coyne's recommendation in this case, correct?
Yes,
50 basis points above Mr. Baldino's recommendation?
that's right.
194 basis points above your recommendation?
Yeah.
And I'd like to use the overhead if that's all right. So, are you familiar with Piedmont's allowed ROEs in the other two states in which it provides a natural gas distribution service?
I can see it right there.
Okay, right. So we've got 9.6 in North Carolina that was approved in January of this year, and then a 9.8 in Tennessee that was approved in May of last year. Do you see that?
Yes.
Okay. Have you looked at, as part of your preparation for this case, did you look at any of the history of this commission's grant of allowed ROEs for public utilities?
Yes.
Okay. And I know you've been involved in some prior cases, water cases. I'd like to show you a summary of the prior history, excuse me, of this commission and granting ROEs for electric and gas utilities. And we'll wait till that gets pulled up here. And I apologize that I'm just going to show you this. This is the front page. And we'll look at the front page and then we'll switch to the back page. But in looking at these ROEs, do you see any ROEs, I believe on the front page here, which only goes to 2015, the lowest ROE is it's still it's a 10.2 or something like that. Is that right?
I see that.
Okay. And then I'm going to flip it over to show you the more recent results. Okay, and so more currently, the lowest ROE that's reflected on this page is the 9.8 that Piedmont, that was approved for Piedmont in its last RSA. Do you see that?
Yes.
Okay. And the lowest allowed ROE for an electric company by this commission in the last 20 years is the 9.5 that was approved for Dominion just about a year ago. You see that?
Yes.
Okay. Now, you were here yesterday and you heard Mr. Coyne testify that the national average for ROE for gas utilities for 2021 and 2022 was 9.53%, correct?
Yes.
And that's just slightly above the stipulated ROE of 9.49, right?
Yes.
Thank you. I want to shift gears just a little bit and talk to you about relative ROEs between electric companies and gas companies. Would you agree with me that historically electric utilities have been perceived as more risky than gas utilities for purposes of setting ROE?
I know that's the case by my calculations in recent years. Historically, I'm not sure. I know, generally speaking, usually water had lower ROEs than electric and gas, but recently I've seen gas has been lower cost of equity for gas than electric.
Okay. So I'm going to switch to a third exhibit here. And again, I'm going to show you the front of this so we can figure out what it is. But this is the S&P Global Report of Major Energy Rate Cases decisions in the U.S. Flip it over in just a second, and you'll be able to
Just
see.
a second, Mr. Jeffries, while we get it on the screen. It's sideways.
Oh, my apologies.
Madam Chair, while they're setting it up, are these exhibits already in evidence and part of the record?
I'm sorry.
Are these exhibits already in evidence or part of the record is what Commissioner Irwin
Oh,
was
is this
asking.
one? I believe that may be right. I think that may be attached to Mr. Coyne's testimony.
Commissioner Irwin, I don't know if you heard that, but I believe this exhibit is attached to Mr. Coyne's testimony.
Thank you. If they're not, for some reason, I'd like to have them be a part of our record. So maybe the council can check that on a break. Thank you.
Certainly. So I'm going to
Just a moment, Mr. Jeffries. If you need to zoom out, you can zoom out a little bit.
Oh, okay. I'm sorry. Thank you, Mr. Hall. There we go. So, Mr. Rothschild, my only purpose in showing you the first page here is to confirm that this is a document you recognize. I mean, maybe not this particular document, but you recognize what it is, correct?
The S&P Global report?
Right. So I'm going to flip it over now so we can see the data that's on the back page. There we go. So you indicated a minute ago that you thought the ORE, the allowed ROEs for natural gas utilities were lower than electrics recently.
Not the authorized ROEs, I don't know that, I don't study that. In terms of my calculations, I've determined that the cost of equity for gas has been a little lower than electric.
Okay.
I don't know what the commissions have decided.
Apples and oranges. What I'd like to focus on here is allowed ROEs because,
Okay.
as I understand that, that's the result, or that's what's evidenced by this document.
Sir, counsel, is it possible to zoom in a little bit on the document?
You know, what I may be able to do is I actually have physical copies of that document if we could distribute it. I'm trying to, I will zoom in on the bottom part because that's the part we're going to talk about.
Okay. And the only reason I'm asking, in addition to the audience in the hearing room, there's also a live audience online.
Certainly.
Here. Mr. Hall, do you need a copy?
Yeah. I'm happy to. Yeah, I want that one. Sure.
Please make sure that any exhibits that are handed up to the commission are first handed to council, if you would.
My apologies, Madam Chair. So if you look down at the bottom of this second page, where the allowed ROEs are being reported, you see that for 2021, the average allowed ROE on equity for electric utilities, which is that, I guess it's the third column on the page, is 9.38. And then if you go over a couple of columns to the highlighted number, it's 9.56 for.
Mr. Jeffries, I hate to interrupt, but when you lean over to the Elmo, we are having difficulty hearing you.
Okay, let me try this. So you can see the highlighted numbers in the third and sixth columns, correct, Mr. Rothschild?
Yes.
Okay, and those numbers that I've highlighted are the annual average allowed ROEs. In the third column, it's for electric utilities, and in the sixth column, it's for gas utilities, right?
Yes.
Okay, and then there are for these last few years on the document, they're also reported quarterly, correct?
Yes.
Okay, so focusing in on those highlighted numbers, which are the annual numbers for 2019, 2020, and 2021, do you see that in each case the average electric ROEs are a few basis points lower than the average natural gas allowed ROEs?
I see that.
Okay. Do you have an opinion as to why that might be the case?
I don't know why. I know now that the numbers, that one chart we showed in my introduction, gas utility stocks have significantly outperformed the overall market since Piedmont's last RSA proceeding in October. I think they were up about 15% while the market was down over 13%. Electric have also outperformed the market, but not near as much as gas. And that's consistent with my numbers that the gas cost of equity for gas utilities is down since the numbers that you show here.
Do you believe market conditions that have occurred since last October could be characterized as normal?
I've heard that market conditions are abnormal as long as I've been in this business.
But you don't concede that the last 12 months, last 10 months have been highly unusual for the market?
One thing I can say, there's usually something unusual. There are unusual things going on, but it seems to me, I don't know exactly why, but something about the war in Ukraine has significantly increased the desirability of gas distribution utilities. That I haven't seen before in terms of that kind of contrast. They've been up significantly compared to electric and water, and unbelievably so compared to the overall market. That I've never seen, that kind of divergence in that short of time.
And in the context of a very large overall market drop, correct?
The market was dropping and the gas utility stocks were increasing, yeah.
Okay. And there's even a phrase for that, right? I mean, don't people call that a flight to safety when the markets are headed down dramatically?
Flight to quality, usually.
Yeah, maybe that's what I meant. No, flight to safety in this case. You're not familiar with that term?
I've heard it many times, yeah.
Okay. So a minute ago, we discussed that the current allowed ROEs for Dominion in South Carolina is 9.5%, correct?
Yes.
And I'll represent to you that it was reflected on that previous exhibit, but I'll represent to you that the current allowed ROEs for Duke Energy Carolinas and Duke Energy Progress are also 9.5% currently. You accept that?
Sure.
So looking at this exhibit that we had up a moment ago, which demonstrated that allowed average natural gas utility ROEs were several basis points higher than average allowed electric ROEs over the last 3 years. If the South Carolina Commission were to follow the national trend in that regard, then you would expect an ROE in this case of a few basis points above 9.5, correct?
I think, if you read my testimony, I strongly believe the commission should make decisions based on capital market data, not these authorized returns. I think that this is the problem was doing this. We're looking over our shoulder and looking at the dynamics that were in the past here. Clearly, right now, I think electric utilities should have a little bit higher authorized ROE than gas. That may change in a year or so, but if we keep looking back like this, we're just driving the car by looking through the rearview mirror.
All right. Are you familiar with the current allowed ROEs for the proxy group you selected?
That's not what I focus on.
All right. You're aware that Mr. Coyne calculated the current average allowed ROE for that group is 9.63%, correct?
Which, as you know, I don't believe is the focus of this proceeding. But yeah.
I'm sorry?
I don't believe this is the focus of my testimony in this proceeding to compare these.
You don't remember whether Mr. Coyne testified to that or not?
I wouldn't doubt it.
Okay. And that's a little higher than the 9.53 that he quoted as the national average, right?
Yeah.
And it's about 14 basis points above the stipulated ROE.
Yes.
Mr. Rothschild, we've discussed a number of average ROEs here in the last few minutes, and I want to ask you if you find it significant that every single one of the ROE averages that we just discussed, and I want to tick them off here to make sure we've got them covered. We discussed Piedmont's existing approved ROEs in 3 states in which it operates. We discussed the lowest ROEs authorized by this commission in the last 20 years for gas and electric utilities. We discussed the current allowed average ROE for your proxy group, and we discussed the national average allowed ROE for gas companies in 2021 and 2022. And every one of those numbers falls in a range between Mr. Baldino's recommendation and Mr. Coyne's recommendation in this case. Do you agree with that?
Yes.
And the settled ROE that's been agreed to by the Office of Regulatory Staff, the South Carolina Energy Users Committee, and Piedmont also falls in that same range, correct?
I'm very happy to keep confirming this data that's available for everyone to see, but I just have to remind that I fundamentally, in the core of my testimonies, we should not be driving the car by looking out the rear view mirror comparing here. We have to look at the financial data.
Okay. But this doesn't suggest to you, this fact doesn't suggest to you that maybe the range we ought to be considering, that these folks ought to be considering, is between Mr. Baldino's and Mr. Coyne's recommendations in this case?
No, I don't think so. I'm sure I'm going to get, I expect from the questions yesterday, I expect some very good questions about this topic coming forward, which I look forward to discussing, because I think there are a lot of important things to consider. But in a short answer here, I'm going to say, no, I think we should, it's very important that we look at the market data. Otherwise, it's to protect both the utility companies and consumers, because market conditions can change where the cost of equity could increase significantly. If we're looking back at that time, utility companies will not be able to earn enough. We can't, I think it's dangerous to keep doing that. I think that's a core part of my testimony. I just want to make sure to repeat that. But with that said, I look forward to further discussions on this topic.
Mr. Rothschild, you're switching over to equity band now. Your recommended equity band for this case is 44.58%, correct?
Yes.
And that's a hypothetical. That would result in a hypothetical capital structure for the company,
But I
correct?
also said that that it would be reasonable for the commission to go with a 50-50 capital structure at this time if it wanted to be conservative.
And 50-50 would be a hypothetical capital structure, right?
Yes.
Okay. Would you agree with me that there's a general preference for the use of an actual capital structure over a hypothetical one when you're calculating a utility's overall cost of capital and capital structure?
Generally, I would say no. With capital structure, there's such a serious problem that we have to look at of capital structure manipulation, and the possibility that a company like Duke can raise debt, the parent level, they have a 42% common equity ratio, and then move the equity to the wholly owned subsidiary. So this has been a serious problem for decades that I've seen this potential for this type of capital structure manipulation. So no, I would say that I really believe the commission should look seriously at this potential problem with capital structure. Why do we need a capital structure in the 54% range when the average of the holding companies of these gas distribution companies is, as my recommendation, under 45%, and that Duke's is in the 42% range? I didn't see any evidence how that computes.
Well, so are you familiar with the fact that Mr. Coyne in his rebuttal testimony calculated a 3-year average equity component for the group of comparable companies at the operating company level that was 55.7%?
That's the key point, at the operating level, yes.
Would you agree with me that the financial markets, that in the financial markets, the perceived risk of a utility by the markets tends to increase as the amount of leverage in its capital structure increases?
Yes,
Okay. And the higher the leverage, the higher the perceived risk.
yes,
And the higher the perceived risk, the potential higher cost of debt.
and higher cost of equity.
My question was about debt.
Well, sorry.
I believe that's all the questions I have for Mr. Rothschild. Madam Chair, I would like to move into evidence the 3 exhibits that we used. I'd ask that they be identified as Piedmont Rothschild cross-examination exhibits, and following the Commission's convention as a consolidated hearing exhibit.
Be hearing exhibit number 9. It's a consolidated exhibit. I think we were only given one copy, a copy of one. What about the other
We have
2 pages?
copies of
Please
the
make
remaining.
sure the parties had those as well.
Yep.
Just for the record, identify the documents. I have the S&P Global document.
He's giving out the other 2 now.
Yes, ma'am.
Yeah, the other 2 are summaries. One is a summary of Piedmont's existing allowed ROEs in the 3 states in which it provides natural gas distribution service, and citing to the docket number and order date authorizing those ROEs. And the third document is a summary of this commission's allowed ROEs and equity bands or equity approvals over approximately the last 20 years. That also cites to the docket numbers, the commission orders from which these numbers are drawn, and the dates those orders were issued.
Thank you.
Did you get those?
Thank you.
Madam Court Reporter, did you get that? How about give her one? Let's see, commissioners. Vice Chair Powers.
Thank you, Madam Chair. Mr. Rothschild, it's good to see you in person with us today. I did not realize you were here yesterday. I think my late mother would say that your ears must have been burning yesterday if you were not here to hear the testimony. A couple of things that I'm trying to understand. When you talk about the capital structure that you brought up, that the capital structure that you felt was proper should be closer to what Duke's is. I think you had 44+% and Duke's was 42+%, which was pretty much the opposite of everything else we've been hearing. Can you explain why?
I think that what I see over and over again, which is concerning, is when there's a great divergence between the wholly owned operating subsidiaries, regulated utilities that have a considerably more equity than they do at the holding company level, or at the consolidated level. And that's problematic because why would, if you have a holding company and a parent company that's making investments in regulated and unregulated operations, generally regulated operations are lower risk, so you would tend to be able to have a greater percentage of debt than for the portions of the business that are unregulated. So why would, if you have a company that has portion regulated, unregulated, when you do all the math, you have the portions of the business that are the least risky have the most conservative capital structures. That's a red flag. It says why? You would think it would be the opposite. So that's why I wasn't convinced by Mr. Bauer's testimony to explain why. I didn't see the evidence. I wanted to see the math behind that, because maybe there's a good reason, but I didn't see it. And so that's just my general concern. When you have such a great divergence between at the consolidated level and the regulated holding company, it brings up, hey, are they increasing the common equity ratio to charge consumers too much? Maybe not, but I want to see the evidence, and I didn't see it. So that's why I'm saying then a reasonable alternative than the request is to go to the average of the capital structures of the companies in the proxy group that we're using to calculate the cost of equity, and that's why I recommended the 44.58. And I said to be conservative would be fine, I think, to be 50-50 at this time, just to be conservative. Maybe there really is a good reason that Piedmont just didn't express in testimony that they could explain, and 50-50 would be conservative.
Well, that kind of leads me to my other thought was that the testimony has been that Piedmont is an average risk. Do you consider Piedmont to be an average risk, being a regulated company with a guaranteed rate of return?
Yeah, I didn't do a deep analysis in terms of comparing, but I would say that it's at in terms of it's at most it would be average risk for distribution gas utility companies. I don't see any reason, especially with the RSA. Yes, I would think that would be the high end, that it would be average.
I think what we were looking at was it's an average risk when you think about things like Ford Motor Company.
Oh.
If Ford Motor Company tomorrow has to recall 10 million pickup trucks, they've got considerable risk that I didn't see with Piedmont. There's certainly a difference between private companies like this and a regulated company as far as risk, is there not?
Oh, that I completely agree.
Okay.
Yes.
The other thing, of course, we've heard a lot about historical data, and I don't think any of us have been here more than 4 years, but explain why you think that your market approach is better than historical data.
I think that going to investors' expectations is the best way to go, because it's investors that provide the capital. So if economists think this, or some analyst thinks that, or journalists write this, okay, but why don't we go right to the expectations of the ones that are providing the capital? Because if we're off on that, they're not gonna provide the money. We want to be on that. So that's why I think going to investor expectations is the very best thing. Now, why historical? You could look at historical behavior of what investors have done, but that is not necessarily representative of what they expect in the future. I mean, it's very clear when you see some event like COVID or something, the market is behaving a certain way, there's an adjustment. Of course, we live in a different world, and that happens all the time when we get new information. So that's why I think going with investor expectations based on market data is better than looking back, because the past is not necessarily going to match what investors expect the future to be.
Okay. Well, I think there's a thought that the past always, when you remember it, looks so much better than it actually was. For all of us in the future, it's so uncertain.
Yeah.
You may not like this question. What would be weaknesses with your approach as compared to using historical data?
Thank you. I would love to have more involved in the proceedings, to be able to actually show humility, and to be able to have kind of constructive criticism and adjustments and a give and take. I mean, that's why I go and I speak with quants at different banks and stuff. I go and test, what models are you using to help your traders? This is how I'm looking at it. And of course, sometimes people might say, that's ridiculous. That makes no sense. Why? And then we go through and make adjustments accordingly. So what would be some of the potential weaknesses? Well, which we really do consider, is making sure there's enough, say, stock option data. If the market is too thin and there's not enough data, you might say you're not getting maybe necessarily really what investors expect, right? And when you have historical data, in some cases with stock price movements, you can have much more data. So that's one thing, but we have looked at that and tested that, and we've looked at comparing our results with when companies have a little bit of less option data compared to companies that have thousands and thousands of data. We're seeing very similar results. So we're continuously trying to watch that as a potential weakness. Is the market thick enough? And we're watching that to make sure that it is. But that is one thing that that we have to make sure we're not fooling ourselves when we look at option data. Is the market deep enough? Yeah.
And you may have answered this for me earlier, but I'm trying to, what are the specific assumptions that make these two approaches different?
Between a historical and a forward-looking?
Yeah.
The specific assumptions would be that the assumption or the kind of approach of going with what investors expect the future to be based on market prices, and that the assumption being that these market prices represent what investors expect. When investors are buying a stock, they're buying it generally because they want to make money. So that represents their expectations. The past, to use that and to say that works, is to say that, well, the future is going to look just like the past. As long as that continues, then historical method would work. And I think we have a lot of evidence to show that we need to be very skeptical of that the past is going to always repeat itself, especially over relatively short time frames like 3 or 4 or 5 years. Things can really deviate. And so I think, just to summarize, then historical would be superior if you just assume that the future is always going to just look like the past. And what we're doing in terms of using option prices is to say, if you think it's superior, to use investors' expectations of the future.
So when you talk about the market price of a stock as opposed to the book value, is it the market price is always going to be higher than the book value, or is it just this particular instance you feel that the market prices, I mean, used in some examples, but are you saying that the market price of the stock of Piedmont, Duke, whatever, is higher than the book value?
For utilities, it's been that way for decades. I think it was before I started. I remember being involved in the business, and at that time there was a period of time when the market to book ratios of utilities were less than 1. And of course, you'll see the arguments were very different at that time in terms of trying, the utilities were really arguing we need to look at the market price, not return on book. Of course, now it's the opposite. So I don't know why, but for decades now, well, I think it's because utility companies have been over-earning. In my opinion, they've been earning, their authorized ROEs have been higher than their cost of equity. And that's led to the market to book ratio to be above 1. And that's why. And there was a period of time, I don't remember exactly, but I think you have to go back about 30 years, where the market to book ratios were, for a period of time, below 1 for utilities.
But specifically, if you buy this stock, you're going to pay more than the book value at this time.
At this time, yes. For the average of my group, I think it's about 1.8 on average. Yeah.
Almost double.
Almost double. Yeah.
Okay. Thank you very much. Thank you, Madam Chair.
Thank you, Commissioner. Commissioner Justin Williams.
Thank you, Madam Chair. Good morning, Mr. Rothschild.
Good morning.
So you're the odd man out, it seems, considering your numbers are outliers and your approach is different than everyone else in this matter, which is why we're having this detailed hearing as opposed to hearing a full and complete settlement. because of that, I'm going to take some time and discuss a few issues with you, if you don't mind.
Look forward to it.
Yes, ma'am.
I apologize.
Take some time. Yeah, let's take
I
a bathroom break.
apologize. Sounds like we've been going. You might take a while. I just realized we've been going about an hour and a half. What if we take a 10-minute break? Do you mind?
Absolutely not.
And let's come back at 11 o'clock. Thank you. Welcome back from this recess. We are continuing with the case in docket 2022-89-G. Let's take a roll call of commissioners. Present in the hearing room, we have Commissioner Justin Williams, Vice Chair Powers, Commissioner Thomas, Commissioner Carolee Williams, Commissioner Caston, Chair Belser, and peering virtually, we have Commissioner Irvin. And we were on commissioner questions, and are with Commissioner Williams. Justin Williams, please go ahead, sir.
Thank you, Madam Chair. All right, sir. So the theme of this line of questioning is understanding. I read a book from time to time that encourages me to seek wisdom, but in all my seeking, I seek to understand. So I'm trying to understand what you're suggesting we should do based off your testimony and the testimony of the other ROE experts. My first question for you, or first line of questions, is in regards to market-based versus a book-based analysis. Is it fair to say that your opinion in this case is that we should use a market-based approach?
Yes.
Okay. Is that the same approach that you used in the most recent Blue Granite case that came before this commission? I believe the application was filed in 2019. The case was heard in 2020. You provided testimony in that water case, Blue Granite. Do you remember that?
Oh, yes. Yeah.
Okay. Is that the approach you used there?
I did. The only difference would be at that time in my it is the same exact approach. Yes, I can discuss some of the slight differences in my methodologies.
Okay.
Discuss.
And is market-based the same approach you used in PWR, another water case that came before this commission in December of 2021?
Yes.
Okay. And so as a best practice or standard, your testimony and position is the market-based approach is the superior approach and the approach that this commission should use in this case.
What I would like to believe my role would be to provide what the market is saying. My interpretation of the market is saying. I don't view my role as to say how you should make your decisions at all, but I do believe that that is the data that should be used to calculate the cost of equity and set the authorized ROE. Yes, but I view my primary role is to provide that information to the commission, what the market is saying. I view as my role.
I appreciate that, but you do understand that you're the only expert that takes this position. So obviously, it would seem that by you taking that position, your position is that we should adopt your approach. Is that not fair?
That's fair. Yeah.
Okay. All right. Is it also fair to say that this market-based approach and calculations of ROE is applicable no matter the utility? Electric, natural gas, water, sewer.
Yes, I have not seen a reason why it would matter between those different industries. Yeah.
Okay, so just to go a little bit deeper, just because we use a market-based approach in a water case doesn't mean we should not use the same approach in a natural gas case or an electric case.
That's right. I think it should be used in all of them. Yeah.
Okay. When you come up with your recommendation for ROE, you use your various modeling and research to come up with that range, right?
Yes.
And I think the specific number that you've come to in this case is 7.86 for ROE.
As a midpoint, yeah.
As a midpoint. Could you remind me of your range again?
Sure. The range is between 6.98% and 8.74%.
Okay, all right. And so your recommendation is the midpoint in that range, and you believe your analysis supports that, correct?
The midpoint, but I also believe it's reasonable for the commission to use any number within that range.
Within that range, okay. And you're familiar with Hope and Bluefield and the position or the law that says it's the result, the end result that matters more than the modeling or the economic analysis.
Yes.
Okay. When an expert comes up with a range, like you have, but decides to recommend a number outside of that range, like has been the case here, the stipulation is 9.49. I think that's outside of the range of witness coin. Or it's not the recommendation that he would make. When that happens, do you believe that it's not supported by the evidence presented? If expert says, well, this is my range, but based on my research, based on the market, based on whatever offerings they submit to us, I think the number should be this. And that number happens to be outside of the range.
Well, as I understand, even in the context of a settlement, that was the context, and he supported 949, right? Even though it was lower than his recommendation.
Well, I'm not asking you about the settlement as a general matter.
Mm-hmm. As a general matter, do I believe it would be possible for me to provide a number outside of this range and still have it be consistent with Hope and requirements of Hope and Bluefield? Is that my understanding of your question?
No. Okay. As a general matter, when an expert provides a range for ROE and then recommends to this commission a number outside of that range, do you believe that Hope and Bluefield supports that type of recommendation if they are making the recommendation based on what's important for the end result and not focusing solely or entirely on the economic analysis that led to the range?
I guess it makes me think of, in terms of my role, as I'm not looking at the overall case. I'm focused on what the capital markets are saying and investors' required return. And that's why I give these ranges. I don't view that as my role to then look at it broadly within an overall context in terms of a reasonable result. I guess in a crazy case, you could say we're going to allow a 50% return on equity and then cut all their operating expenses here, and the number comes out to the same, right? I guess Hope and Bluefield would say it's fine, it's a reasonable result, even though each of the pieces are out of whack. I guess that would be in the hands of the commission to make that kind of judgment. But for me, from my view, I'm looking at this piece in terms of the rate of return component. This range, I believe, would be consistent with the requirements of Hope and Bluefield.
Okay.
Does that answer your question?
We're getting there.
We're getting there. Okay.
We're getting there.
Good.
So, again, for example, in this case, your recommended ROE is an outlier, right? Compared to the other expert witnesses in the same subject matter.
The recommendation, but some of the result ranges are similar to Mr. Baldino's.
Right, but I'm talking about the recommendation.
Yes.
All right. If you or any other expert looked at all the cross-examination that you had from the applicant's attorney, that if we adopted your range or adopted your recommendation, it would be the lowest ROE in 40 years, so forth and so on. If you looked at, or another expert looked at all the information presented here, looked at the fact that your ROE is lower, recommended ROE is a little bit lower or a lot lower. And they said, hey, you know what? In order to ensure that the utility has the opportunity to earn a fair rate of return, in order not to make too much change too quickly, in order to provide some level of stabilization or certainty, if you will, even though my range is whatever your range, I think, tell me your range again?
698 to 874.
698 to 874. Even though this is my range, I think in this particular case, 9.0 supports Bluefield and supports Hope.
So my understanding would be kind of a concept of maybe gradualism, that in one scenario, the commission here may say 698 to 874 we think is well supported by the evidence, but in terms of an interest of gradualism, maybe something outside of that range, 9%, could be appropriate. Would that be?
That's what I'm asking you.
Yeah.
What are your thoughts about that approach?
I believe that's, I've discussed this before in other testimonies. I could find that to be reasonable in terms of a commission saying, look, this would be the lowest authorized ROE in the last 40 years we're concerned. I strongly believe, and I communicate this over and over, that I think utilities have been over-earning for decades. I think it's a serious problem and consumers are being overcharged and economies are being harmed by this. And I believe the math is very clear that this is true based on what I've discussed in my testimony. The math is really looking in front of us. Stock options and these things are helpful, but I think we can look at it, just the math is standing right in front of us with these market-to-book ratios near 2. When the authorized ROEs are being applied to book, it's just really as factual as you can get in finance. But I still would support an idea of saying these services are extremely important. We don't want to have any kind of risk. We want to be conservative. We want to watch and move in that direction. I would certainly respect that and understand that.
Thank you for sharing that, and thank you for offering your opinion regarding respecting and understanding that decision. But my question is, do you think that approach is supported by Hope and Bluefield based on your understanding of those two cases?
That's a great question. I would say, as someone who's, I like to think of as being somewhat passionate about the research and what it's saying, my first thought is, no, we really must be consistent. These are what the facts are saying. But I do understand the idea of a compromise being somewhat reasonable. So I think the essence of Hope and Bluefield should be to be moving towards this range, and I think really it should be something that we should strive for and would be the most appropriate here. But I do believe that given maybe the idea, let's make sure, let's move in the right direction and be extra conservative, I would say that could be consistent with Hope and Bluefield. And I think I'm probably speaking somewhat paradoxically here, but it's because I think we should really be moving this direction. I believe this is the evidence that represents what the real cost of equity is, and that's the authorized ROE should be consistent with this to be consistent with Hope and Bluefield. But I can understand that we could move gradually and that would be very reasonable.
Based on the Hope and Bluefield standards?
Yes.
Okay. Now let me pause here and give credit where credit is due. I don't know if you know this or not, but we haven't always had, since I've been on the commission, a DCA as an intervener. So, but for some change in the law here in the last 4 years or so, 3 or 4 years, you're having the opportunity to present this type of testimony. So I don't know what the outcome will be, but it's definitely worth noting that but for the DCA intervening, we wouldn't be having this conversation. But for the creation of the DCA in this lane, we wouldn't be having this conversation. So from our vantage point, we've heard all this testimony, And if I understand what you've just said, you believe that Hope and Bluefield supports this commission making a determination that a certain number for ROE outside of experts' range could be supported by Hope and Bluefield.
Yes, that would be my opinion, with the caveat that it's recognizing of moving in that direction and appreciating and evaluating this more. I would support that.
Okay. And so when we talk about the various ranges that have been offered, would it be fair to say that's more for that information is given to us for us to reach a ultimate conclusion based on what we believe the evidence of record supports, and not to be tied to your range or witnesses Coyne or Donald's range? Like we're not handcuffed to any expert's range, are we?
That's my understanding. I've seen that in various proceedings where there's been a lot of discussion about making sure the decision is within various ranges of various things. But it's my understanding the commission has the authority to make their own decision. That's my understanding, that these ranges are guides for them to be able to make that decision. Of course, I stand by this range very strongly, and I think it's well supported, and I think the commission should take this very seriously. But it's my understanding that it's then in the commission's hands to weigh all of the evidence.
Understood. And rest assured, we take every witness's testimony very seriously, including yours. So let's move to the stipulation. The recommended or offered ROE with the stipulation stipulated by the applicant, the Energy Users Committee, and the Office of Regulatory Staff is 9.49, right?
Yes.
Okay. So based on the fact that we're not tied to a range, based on your understanding, based on the fact that we could select a number that's outside of that range if we found that number led to the best result. 9.49 is not unreasonable, is it?
Well, I think it is. Just if we just look at rate of return, I think it's too high. I do. I think it's too high.
Right. And that may very well be correct, that if we were just looking at rate of return is too high, but we're not just looking at rate of return, are we?
No, I understand. Yeah, you're looking at many issues. Yeah.
Right. So we're not just looking at rate of return, are we? So if we look at the case in entirety, in its whole, then 9.49 is not unreasonable on its face, is it?
Well, I just have, from my perspective, I'm just so concerned about all this talk of looking at other authorized ROEs in the past and continuing this problem of just perpetuating the past and not really adjusting. So that's my only concern, is then the utilities in the future will be able to continue to point to that 949 in the future, and I think that's too high. If within the whole context of this case you see the full balance, and with Hope and Bluefield it's reasonable, then of course that's the commission's decision. But as a rate of return witness, my concern is we're continuing to harm consumers and the economies of states when these authorized ROEs are too high. And this will still be in the record in the settlement, is my understanding, as 949. And I think that's dangerous because we're going down the road of continually overcharging consumers. We just had, for years, interest rates were unbelievably low. Utilities were saying interest rates are about to increase. We need to keep ROEs too high. Overcharge consumers a lot of money for a long time. I don't want to keep doing that. And that's my only concern. If we say 949, it's above what the market is saying, but it's reasonable within a broader context. If that is what's best and the commission decides, that's fine. But my concern is then we're going to get in another year or two that utility attorney's going to put up there on the chart again, 949, look at that. And it's going to perpetuate overcharging consumers. That's my concern with that.
Thank you for sharing that. Just because you think it's too high, 9.49 is a ROE. Just because you think that's too high does not necessarily mean that it's unreasonable, though.
I guess what would be range within what would be determined reasonable. I think just looking at rate of return is not reasonable. It's unreasonably high. Again, I view it outside of my scope to determine whether it's reasonable within a broader context. But I think it's unreasonably high for just rate of return, or just
Okay.
ROE. Yeah.
All right. So I think I understand you. I just want to make sure when I'm writing my order and I'm citing to your testimony and transcript that you're really not answering my question. You're saying it's outside of my scope.
I think that's the best way to say
Right?
it. Yeah.
Okay. So you're not saying yes, you're not saying no.
But when you go within my scope, I'm saying no, it's not reasonable. When you talk about rate of return world, it's unreasonably high. Yeah.
Right. But you admit or acknowledge, I should say, that we're responsible for considering more than just simply rate of return, correct?
Yes.
All right. Let's talk about your concern, because it's a very valid and fair concern, overpayment. What happens if we go with the lowest end? What could potentially happen, because this is a projection, a forecast? What could happen if we went with the lowest end of your range? Even though you made your recommendation, but we went with the low point, the low end.
698.
698, and some massive weather event occurred that destroyed the utilities infrastructure, and they needed access to capital, a large amount of capital. Could the low end of your range make it more difficult for them to access the necessary capital to make repairs?
This is a very great question and very important, because if I were a commissioner, I'd be thinking about this a lot. And if I decided to go with 698, I would be seriously considering that and making sure that the utilities would have access to capital. And in that case of going with the 698, you would have to make sure to really watch carefully. And one of the issues that we see, which is what you hear often over and over and over again, these services are so important. Maybe we could raise capital now, but maybe we couldn't in the future. They can always use that argument. It's a fear thing. We need to charge consumers higher because maybe in the future we wouldn't be able to raise capital. I think that's kind of asking consumers to pay a very large kind of insurance policy to investors. They're saying we in my opinion, what we're saying, if we especially go with 949, is asking consumers to pay considerably above what the actual cost of capital is. And with that logic, maybe that makes sense because they may need to raise capital in extreme situations. Therefore, we're giving a real kind of basically consumers to pay an insurance policy. I would not support numbers that would put the utility at risk of not being able to raise the funds it needs to provide safe and reliable service. That's not in the best interest of consumers. That would be devastating to consumers. I don't think it should just be as cheap as possible. So when I give these numbers and these ranges, I'm looking at the market data to take that into consideration.
Well, it almost sounds as if you're saying the low end of your range is too low.
My concern would be, as a commissioner, with going with the 698. I do believe they would be able to raise capital, but what I've already been seeing in other proceedings is this comment: if you go with this with Mr. Rothschild, we're going to be in big trouble. We're going to get a credit downgrade. We're going to be. I keep hearing that. One possibility is that they could, and I did see this in a proceeding in Connecticut after my recommended ROE of 717 was being considered by the commission. The utility Eversource was already starting to say, there is word on the street that our credit rating is going to be impacted. I didn't see that, but that's what would be some of the concerns here when we talk about finance, is what could what could be kind of constructed as a way of talking about the influence. I believe that this is what the data is saying, 698 to 874. I believe that would be consistent. This is why here I would recommend more toward the range. If you asked me today, should we go with 698? I would think it would be better to go within the middle of the range, in my opinion. I would not, in this case, I think of moving towards that, but I would think the middle of the range, I would prefer much over the lower end if we had to choose. Yeah.
I appreciate that acknowledgement. That means a lot. You're testifying on behalf of the consumer advocate. Generally speaking, they represent the average ratepayer, Joe ratepayer, in this proceeding. When you talk about your range, low end versus high end in the midpoint, and the discussion of whether or not a utility would be able, this utility would be able to raise capital to pay for massive repairs in the event of an extreme weather event or some catastrophe. And you were having that conversation with Joe ratepayer or Jill ratepayer, and you said, hey, your electric or your gas bill, can be increased by 25 to 30 cents per month, right? But if we have a catastrophic weather event or some unforeseen 10,000 year event, 1,000 year event, you could spend a week in the cold while we try to figure out what we're going to do. Or you can pay what the parties to the stipulation offer to us. I think it's about 84 cents or so. You could pay this amount of increase, and we believe that the likelihood of not being able to perform and function, even in the face of an extreme weather event or a catastrophe, is slim to none. Do you think, and I'm not asking, obviously you're not a mind reader, but just considering those options, do you think it's not fair and reasonable to pay what you describe as an insurance policy if the utility that is responsible for providing safe, reliable service offers to the commission that this is what's necessary for us to perform at the same level that we've performed in the past, for the past 20 years?
Well, the only problem with that is that's what the utility companies always say. We want to make sure the lights are on. You don't want the lights to go out or the gas to not be served. And it's very hard to determine. I believe the evidence is showing they're just overcharging consumers, that they don't need that, But that's why I do understand about being, it is reasonable to consider that and to be conservative. But that's when I do this data, I'm saying, no, that's overcharging. We have to make sure a utility can always say that. We need this to be able to be there for consumers. But how do we know when they're just simply overcharging? And that's a major concern. I don't think we should just give the utilities the benefit of the doubt and say, yeah, they say they need that, and they're just need that to be able to serve their customers. I think they should be asked to really quantify that, and if they need it, then they need it. But my concern is they just that it's not true, that they're just saying we need this. But instead, it's really just money that's going out to investors, and consumers are overpaying. If consumers are paying for something like the ability to deal with extreme events, then that's worth it. But my concern is that consumers are overpaying.
All right, so I'm going to close out with just fleshing out this whole overpaying concept here. While I understand the theory of overpaying, you're not able to provide a hard and fast figure or amount of overpayment, are you?
Well, I think that in terms of the profit, because this is only one part of the puzzle, as we've been discussing. In terms of the profit, I think this range is some pretty solid evidence behind this, that this would allow them to raise a safe and reliable service. But that doesn't mean there can't be other ways to ensure that the utilities have money to deal with extreme events. We don't have to just say, let's give them above market return in order to deal with that. Maybe another way, there are many other ways to potentially ensure that they have that access to the necessary funds. For one example is the ability to, after a storm, to charge consumers through a securitized bond of some kind or something like that. That's commonly done. I know there's, I think, legislation underway in South Carolina to consider that. So that's just another way. You could say, let's give them the market-based cost of equity. If there's an extreme event, we'll have the legislation and different options in place to be able to have them raise the money they need to repair the system.
Okay, but if those other ways that you just identified aren't available here in this case, or aren't available here today, we can't consider those other ways, can we, in this case, if they're not available to us today?
That's possible. I just, from my perspective, again, as rate of return, I think that's dangerous to give utilities above market return in order so that they can have access to the capital needed. I think they should earn their market-based return and then at the same time to make sure the utility is able to handle whether it's an extreme weather event and raise the capital necessary or other kind of extreme things. It makes me uncomfortable to say just throw it into the ROE number. I'm dealing with that in California with the wildfire risks in Pacific Gas and Electric, and that's what they've often been saying. Just give us an extra ROE for this wildfire risks and all these other things. I don't think that's a good way to go for many reasons. I think we should be looking at a market-based cost of equity. Actually, in California, it's more complicated than that, but in general, I would say market-based cost of equity, and then in other ways, make sure that the company would have access to the capital and needed in extreme events.
All right. Thank you for answering my questions. Before I yield, is there anything else that you would like to say based off the questions I've asked you?
I think that's it. I really appreciate your questions and and the opportunity, I think, to really get to the heart of trying to go about choosing the right numbers here. It's in the best interest of the company and consumers, and I appreciate your questions.
Thank you, sir. Madam Chair, nothing else.
Thank you, Commissioner. Commissioner Thomas.
Thank you. Good morning, Mr. Rothschild.
Good morning.
Been talking a long time, but it's still morning a little bit anyway. So you just mentioned the securitization, and I don't really have a question along those lines, but just a thought or a comment. South Carolina has passed a securitization law now, and my understanding is that it is only applicable to electric utilities. And interesting to me, one of the extreme events that was named in the legislation would be earthquakes. And it seems to me like the earthquakes would have the biggest impact on gas utilities. So I just find that a bit curious. You mentioned that, so I just thought I was going to toss it out there. So let me ask you, I guess, a little bit of a follow-up question. You talked about the potential for equity manipulation when, particularly when you're part of a larger group of companies. And I believe that I understand the points that you were getting at. Did you cover that to the extent that you wanted to? Do you have anything else to say about that?
I think I said everything. It's important to recognize, I think this has been a serious issue for many decades, and sometimes it's even a bigger issue than the ROE. I think it can be a way where a lot of unjustified profits are going to the utility. easier to hide that kind of thing. And ROE is just a number sitting in front of you, but when you talk about an actual capital structure and to understand how that could be funded through, it's harder to see. So I think it's just important to remember that ROE is often focused, but capital structure is a really big deal, has a big impact on rates.
Okay. So, again, kind of getting back to the bigger picture in terms of what we're trying to do here, or at least from our side of the table. And you mentioned, the rating agencies, and I guess my concern would be that if we do go with your recommendation or something closer to that, and that gets discussed all the time. What's the impact going to be from the rating agencies? And I know it's not your job to work with or talk with them, but just out of curiosity, do you have any firsthand knowledge of what the rating agencies think about your approaches and your numbers, or are you just kind of hearing through the grapevine?
Well, I spent a considerable time addressing that in a case last year, an Eversource energy case, and what we did was the utility said that if we adopt your authorized ROE and capital structure, we're going to get credit downgraded, and although consumers are going to really pay in the long run, said, show me the calculations. They're going to decrease the credit rating and increase various ratios, cash flow over debt. There's 3 or 4 of the common ones that Moody's uses. And we went through and actually calculated it. And it looked like that it probably would not lead to a downgrade if it had brought in the numbers. But in the extreme case, if it led to one notch, consumers would have paid about $100 million less in terms of when you went and implemented my recommendations, and you get let's assume a credit downgrade happens. Consumers' cost of debt would go up, and then they pay about $20 million more. So the idea is, or I think in the extremes, it was 10 to 20 million. So that's what the number said. Consumers will benefit by about 80 million, and they'll pay about 10 to 20 million more. I think Mr. O'Donnell said yesterday this was I forget the exact term, but basically a poor argument to say, hey, you're going to do something that's going to maybe reduce rates in the short term and then lower credit ratings, and consumers will pay in the long run. And he saw the evidence is, I think, 8 to 1 or something. Consumers are saving 8, paying $1. So that's a very common argument. And there isn't, and I've seen they're usually just vague. Oh, we're going to be in trouble. The credit, we're going to get downgraded and everything's going to be bad. Show me the numbers, show the calculations. Mr. Bauer didn't do that, but when I saw that and really did it in detail in Connecticut, consumers were going to benefit, even in the extreme case where there was a downgrade. So I think it should be taken very seriously what the credit rating agencies do and work with them. But I think we shouldn't just say, "Oh, consumers are going to be harmed," even if there is a downgrade and a slight increase in the cost of debt. Did you do a cost-benefit analysis? And in many cases, consumers would benefit when you net it all out.
Okay. So switching to a different area, I know, as we've said, that you're here representing the consumer advocate, and that's the way you approach this from the get-go, is we're looking at it from that standpoint. And then it came somewhere along the lines that negotiations started happening and trying to work out an agreement that the parties could all live with. And obviously you all did not sign off on that. And I would guess that you probably weren't one of the ones that was part of the negotiation. Were you a party to that, or was it really attorneys, or you?
Yeah, it was very indirectly. I don't remember how much, but very little. Yeah, very little at most. Yeah.
Okay. All right. Well, and I guess one of the things that here, just the whole big picture, there's been a lot of comments about the outlying numbers and calculations and so forth. And again, this wasn't your focus, but the ability to perhaps negotiate and reach an agreement, it just seems to me like it would be helped if there were some a little bit more of, let's try to come up with something that's closer to the range of the others. And I don't know how you get there. I mean, you were talking about your recommendation on equity was 44.58, but you'd be okay with 50%. And I don't know. I guess I was just thinking that, was there anything along those lines too that might help feed into a settlement where your part would at least look like it's being counted?
Well, what I hope is that the commission will just use this as evidence in terms of making a decision. I think as we were just discussing, I view my testimony as to show you what the capital markets are saying in terms of the costs, and that within this range, particularly a midpoint, would allow the company to raise capital. The 786. I have a range that goes up to 874, but I think that this data can be used to be comfortable, to help the commission make a decision. And that if you go within these ranges, my recommendation is the company would still be able to raise money, and that the 50-50 capital structure, if it wants to be conservative, could use that. But then the commission can take that information. That's my testimony, that this is what the capital markets are saying, and also my analysis of the capital structure request, and that's what I can offer.
Thank you. I appreciate your input.
Thank you.
Madam Chair, this is Commissioner Irvin. I have a few questions.
Commissioner Irvin, please go ahead.
Thank you. Mr. Rothschild?
Yes.
Good morning, sir.
Good morning.
You mentioned that in order to get to your range, that you would need to do a cost-benefit analysis. Have you done that for this case?
A cost-benefit analysis for the capital structure, right? I think that's what you're referring to.
Correct.
No, I have not. I identified that Mr. Bauer has not in my surrebuttal testimony. I think in my direct, but particularly in my surrebuttal, he has not done that, and I think that would be helpful to be done. But I have not done that myself. No.
So you're asking us as a commission just to assume that it would save consumers money. You don't have any model that you've used to ensure that we would save money if we adopted your range, do you?
I think it's a big red flag when the company is asking for a capital structure with a common equity ratio that's significantly above that at the consolidated level of the companies in the proxy group that we all use to calculate the cost of equity. It's a big red flag. Also considerably above the parent company. And so my role is to identify that, and that I think the company should provide a justification that they have not.
Well, you didn't answer my question. My question was, you knew you were coming to testify in this case, and you knew that you were going to assert that customers were being paying too much under the company's ask. Why didn't you do a cost-benefit analysis to support your position in this case?
I think the evidence that I provided is helpful for the commission in terms of the capital structure ratios of the companies in my proxy group, and also of Duke Energy. I think those are valuable pieces of information to consider. In terms of there's always additional analysis that could be done. I think that would be something that certainly could be helpful. Why didn't we do that? We have to choose which things to focus on, and I believe that what I provided in terms of the capital structure was significant evidence that could help the commission make a decision. Could more be helpful? Yeah.
Yes, sir. You understand we have to weigh the testimony and evidence, and we also have to consider the factual basis for expert opinions. You understand that's part of our role in this case.
Yes.
And since you've not done a cost-benefit analysis, would you agree that your opinions are not supported by your assertions?
I think they're supported by the data that I provided in terms of the data that I did provide. I think that does support it. Could additional analysis be done? I agree that would be helpful. I do not know why Mr. Bauer was so provided his testimony didn't provide that. I think that
let
would
me
be
ask
helpful.
you did it in Connecticut, didn't you? Didn't you do the cost-benefit analysis in Connecticut? That's at least what I understood you to say.
Yes, that was it turned out to be I'm having deja vu now. We were at this spot just like this, and we decided that that was going to be important, and we set up a whole nother round of hearings to do that very topic. And so that was done. That was a choice that the commission made to have another round of hearings. It took considerable time, but was very, very helpful.
Well, so you had that learning experience. Why didn't you incorporate that into your methodology? Knowing that that's important, if you thought that was so important to support your position, why haven't you done it for South Carolina?
I think that would be something that would be very, very helpful going forward to look at. Why? It's just a decision that has to be made with what to focus on. I provided the evidence that I had, and I think that could be something that would be valuable to look forward in the future. I think,
So you thought it was important for the ratepayers in Connecticut, but you didn't think it was important for the ratepayers in South Carolina to have that methodology presented to us.
I would agree with you. It's very important. I think that's why I think Mr. Bauer should have provided it. I was asked specifically by the commission in Connecticut to do it, and I did provide that.
Well, let me switch gears just a minute, and I believe it was Commissioner Thomas asked you earlier. You weren't a part of the negotiations that led to the stipulated settlement agreement in this case, were you?
No, I very indirectly provided some numbers, but I was not. No.
You were not in the room when it happened, right?
No.
And so you don't know what kind of considerations came into play to reach a stipulated settlement agreement on numerous factual issues in dispute. You don't have any knowledge of that, do you? What parties gave up and what they got in the terms of this negotiated settlement agreement? You have no knowledge about that, right?
No, that's not my testimony, no.
Well, what did, let me just ask you this. You're aware that the Office of Regulatory Staff is charged by law in South Carolina with representing the public interest, correct?
That's my understanding, yeah.
And they are a signatory to the stipulated settlement agreement, correct?
Yes.
And so can't you assume, and can't we assume that they felt in entering into this stipulated settlement agreement that the public interest was protected under the compromise settlement? True?
That's certainly their role. Absolutely. Yeah.
Exactly.
Yeah.
And they wouldn't have signed a stipulated settlement agreement if they thought it was against the public interest, would they? They'd be violating the law, correct?
I wouldn't think so.
Right. And the same is true for the ratepayer group that's intervened, represented by Mr. Elliott. They certainly are concerned about the rates that their customers are going to be paying, but they also agreed to enter into this settlement agreement and be bound by it, including the cost of equity and the ROE. And so doesn't that indicate that they were satisfied with the stipulated settlement agreement in this case by signing on and agreeing to the terms of the agreement?
Yes.
So you're telling us just to ignore those parties and their wishes to settle the case so that we can give you more time to go back and do a cost-benefit analysis and come back for a new hearing? Is that what you're asking us to do?
No, I'm not asking for that new hearing. I just think, I believe the company should not be allowed to ask for such a common equity ratio that's so extremely high without providing the justification of gross benefit analysis.
Well,
I
the company
provided,
excuse me, the company did compromise, didn't they? They came in their petition asking for 9.9%, true?
yes,
And they compromised to 9.49%, true?
yes.
So they've given up their initial ask in a spirit of compromise, and they probably got some other things that benefit their side. We don't know because we weren't in the room. You weren't in the room. I was not in the room. But that's why they call it a compromise settlement agreement. And by the way, have you read the stipulated settlement agreement?
I have read portions of it, yes.
Have you read paragraph 24, which says that if we don't follow the stipulated settlement agreement in any material way, any party can withdraw. So if we take your testimony, decide to adopt your methodology and reduce the ROE, did you know that any of these parties, including the company, can withdraw their consent agreement? And we'd have to start all over and try this case again. Do you realize that?
Madam Chairman, I'm sorry, Commissioner Urban, to interrupt. I'd be happy to clarify that, but I believe that is a misinterpretation of the settlement agreement. It's actually a point I was going to try to make during closing today, but
Let me read it to you, counsel, if you don't mind. Let me just pull it up. It won't take just a second. Because I was reading over it yesterday, and it caught my attention. I'll open the settlement agreement. If you have it with you.
Yes, sir.
Let's turn to page 20. Let's see what's paragraph number 24, as I recall.
Just a second, Commissioner Urban. Mr. Hall, do you have a copy you can give to the witness?
I actually do not. I'm
Okay,
sorry.
that's okay.
I can
Commissioner
read it.
Urban, please go ahead.
Yeah, I can read it to you. The pertinent provision, pertinent part of the provision in paragraph number 24 is, and I quote, if the commission declines to approve this stipulation in its entirety and without modification, then any party may withdraw from the stipulation without penalty or further obligation, end quote.
And Commissioner Urban, and I will.
Yeah, Commissioner Urban, will you hear from Mr. Hall?
Sure.
Okay, Mr. Hall.
Thank you, and I will look to other counsel to please correct me if I'm wrong. And I will say that I sort of see where you're coming from, but this agreement would allow the commission to adopt everything that the three other parties agree to and insert their own ROE and capital structure. And that is contemplated in this agreement. So that is actually the stipulation in its entirety, is that there are almost two options. One is, yes, certainly the commission can adopt the 9.49 and the 53.5 capital structure and all the other adjustments. It has that option. Their other option is to adopt everything else and insert their own ROE and capital structure. And then the third option would be.
Could you cite the agreement for me? Because I don't see that in the agreement. Could you direct me to the appropriate paragraph?
Commissioner, I would look at the first phrase in paragraph 24, please.
Okay.
And essentially, yes, it does, except as otherwise provided herein. It's likely, Commissioner Urban, a combination of several components. I would look to, again, co-counsel to see if they disagree with me in how I just described the stipulation agreement. Again, do not want to get into settlement discussions, but that is my understanding, and I believe the way I described it is also their understanding.
Commissioner, if I may,
I I'll withdraw the question,
Yeah,
Madam Chair.
I mean, I think council can address this, but I don't know that the witness is an attorney.
That's my point. My point was, Mr. Rothschild, is that the parties went to great lengths to try to reach a settlement agreement, and you would agree that in any settlement, there's give and take. Would you agree with that?
Yes.
And you would also agree that under this stipulated settlement agreement, the company agreed to reduce their ask. And so that inures to the benefit of all ratepayers in South Carolina that are subscribers to Piedmont Natural Gas. Would you agree with that as well?
Excuse me, can you repeat that question?
Yes, sir. The company compromised their demand, correct?
Yes.
The initial demand was 9.9, and they compromised and agreed to accept 9.49. Is that true?
Yes.
Okay. The final point I want to ask you about is the history. You know, there's a common phrase that we all use: hindsight is 20/20. And we have an exhibit now that's part of our record that shows that what you're asking us to do to adopt an ROE in the range that you've given from 6.98 to 8.74, I believe. Is that your range?
Yes.
That's never been done by the South Carolina Public Service Commission in the past 40 years.
For gas
It's been
utilities.
established in this case. You're aware of that.
For gas utilities.
Gas utilities, it's never been done, right?
Yes, but it has for water, but yeah,
But not gas.
not gas. Yeah.
And so don't you think that if we turn our back on 40 years of precedent, don't you think that's going to catch the eye of some rating agency and say, what in the heck is going on in South Carolina? They've departed from their historic ROE for the past 40 years by cutting below any other outcome in the history of the commission in the past 40 years. Don't you think that's going to catch somebody's eye?
And it's this,
Standard & Poor's?
and it's this logic that's led to consumers being overcharged for decades. We can't go below these authorized returns in the past. It's dangerous. Credit ratings could be harmed. Consumers will be harmed. Overcharging consumers for decades.
And isn't there some truth to that statement? And let's be honest, you're under oath. Isn't it true that if Standard & Poor's downgrades Piedmont's credit rating, consumers will have to pay more because the rates are going to go up when Piedmont goes to the market to borrow money? So it's true, isn't it?
In terms of overall, I believe that if we went within my range, or particularly 786 or in the 874, consumers would pay less. That's my testimony. If there was some kind of downgrade, it could increase cost of debt some, but consumers overall would net benefit. That's my testimony.
But you still haven't done a study, a cost-benefit study for South Carolina, have you? You knew you were coming to this hearing. You knew you were going to be asked about it. You even told us you did one in Connecticut, but you didn't find the time to do one for us in South Carolina, did you?
I didn't. I provided the evidence on that topic in my testimony that you can see.
But no study was performed on a cost-benefit basis, correct?
I did not do that.
Thank you. No further questions.
Thank you, Commissioner Urban. Commissioner Caston is recognized.
Thank you, and now it's good afternoon, Mr. Rothschild.
Good afternoon.
And I had some very organized questions that I wanted to ask, but all these other questions had just totally messed that up. Relative to, I guess, the question that Commissioner Irvin asked on benefit cost analysis, did Mr. Coyne or ORS's expert who, excuse me, I forgot his name.
Aldino? I think,
Yes,
yeah.
Mr. Badino. Do you know if they provided any benefit cost analysis relative, for example, I think, I'm looking for my notes. I think relative to, maybe Mr. Corn talked about the effect it would have on higher interest rates in the future and such as that. All I'm asking, all things equal, did any other experts provide any benefit cost analysis to make their arguments or points?
No. They did not. They did not provide that cost benefit analysis.
Okay. Just kind of curious because in my previous life, I participated in many benefit cost analysis because that was another wonderful thing about engineering. You know, we looked at those things, but I'm kind of curious, how would a typical analysis of benefit cost analysis be performed relative to this?
So the way that I've seen it done before is you would, for example, I show in my testimony that when we look at the revenue requirement of Piedmont, I provide the percentage. It's on page 9, table 3 of my direct. It shows. Would you like me to wait? Are you going to look at that, or okay, I'll wait.
What was that, page 9?
Page 9, table 3.
I brought my glasses this time. Okay.
So I calculated in that table based on a $505 million requested rate base. I think my understanding of the settlement was a little lower, but it's about the same, 501 or 502. So the numbers wouldn't be much different. That if my 7.86% ROE and my capital structure recommendation, 44.58, was adopted, the rate of return portion of the revenue requirement would be 34.58 million. If Piedmont's request, which is a 9.9% ROE and 54.56% common equity ratio, that would be $46.24 million, the difference being 11.66. So what we can do is flow this through in terms of how this would impact the various credit ratios when we take out this $11.66 million from the revenue requirement and look at the 3 or 4 different credit metrics that Moody's uses or S&P, and how much would that impact it? And they usually provide a range for each of those credit metrics that would be various credit ratings, and we could see how would that impact those. Would it bring it out of those various ranges or not? And then we could say if it would lead to bringing it out of that range, and it was a credit downgrade of half a notch or something, then we could look at how would that impact the cost of debt. Would that be from going from a credit rating, for example, of BBB plus to BBB? How would that impact the cost of debt? We can look at the cost of debt market and say that would be 20 basis points, let's say. And instead of a 4.08 cost of debt, it may be 4.28 or 4.38. We could determine that, and then we could say, well, consumers are getting the benefit of a lower authorized ROE, but that would flow to, let's say, to a potential credit downgrade and another 20 or 30 basis points increase in the cost of debt, and we could compare. Consumers are benefiting from the lower cost of equity. Presumably, consumers could be harmed by a potential increase in cost of debt. How does it, what's the trade-off? That would be the cost-benefit analysis.
Okay, to make sure I understand this, and I'm going to be very general. So basically, you would go through iterations of various ROEs and, I guess, debt-to-equity ratios, and come up with similar to what you had in your table 3 on page 9. And then I guess there's some methodology to look at what effect that would have on ratings. And through those iterations, a rating for each iteration, and then, okay, what effect would that have, you're saying, on debt, interest rates, in essence?
Yes.
And that's what you're saying the benefit cost would be. So if instead of whatever it is, instead of X, it was Y, which was lower, and the downgrading increased, the equity level is less, but the debt level percent would be more. You simply look at, okay, what is the cumulative total or whatever of that return on equity at that rate? 100 million, say, that you're saying would be different, that say a customer would not have to pay, but he might pay 20 million more on debt. So you're basically looking for that net difference, whether it's positive or negative or what. That's what the benefit cost analysis does.
Yes.
Okay. Did any of the other experts do that kind of analysis? I think you've already answered it, but I want to make sure.
Yes, they have not done that.
So no one has done that in this proceeding. No one.
No, that's correct. There's no one that has done that.
So we can talk about it till the cows come home, and it really doesn't matter, does it?
I think it should be done. I think Mr. Bauer made a lot of claims alluding and stating that consumers would be harmed, that it would be short-sighted to go with my recommendation, because although rates could go down in the short term, that could lead to credit downgrades and they could harm consumers in the future. There's no basis to that other than this is a risk. I would want to see those kinds of calculations to really be able to support that.
I absolutely see the merit and benefit to that. It's a shame we don't have that, but we do not currently.
We do not currently.
Perhaps next go round we can.
Yes.
From everyone, maybe.
I would highly recommend that.
All right. And listen to the other questions generated thoughts. And we talked about risk. We talked about a host of things. So bear with me as I go through my absolute chaotic notes. Beta. That's one of those magic things out there, right?
Yeah.
As I understand beta, and you correct me to the scintilla where I'm wrong. As I understand beta, it is simply a risk adjustment factor. We call them coefficients with some of the equations we had, but it's an adjustment factor based on risk, correct?
Yes.
And the risk isn't, the risk is, let me try to think how to define risk. I think as Commissioner Powers mentioned earlier, a non-investor-owned utility such as Ford, and they have their projected earnings or what they say they're going to do. The economy just goes to heck that particular year or whatever. Do they have greater risk than an investor-owned utility such as Piedmont?
Yes, and you would generally see that in higher betas. I don't know what it is for Ford Motor off the top of my head, but generally for a company like that, you'd see higher betas than for regulated utilities.
So if that's the case, beta means if 1.0 is norm, not a lot of risk, not a lot of safety, you're just kind of the norm there. Anything less than 1.0 means you're fairly risk-free or have protections in place or whatever that minimize that risk.
Yes.
That's-
Yeah, a beta of 1 would say as a risk equivalent to the overall market, less than 1 would be less than the overall market and greater than 1, greater. Yeah.
And if it's greater than 1, it's a higher risk because it might be a company that maybe isn't as financially strong or secure or maybe in a more volatile market, or why would it be greater than 1?
So for something, say in retail, and many times they're highly impacted by the economy, and so, especially if it's more expensive consumer goods, they tend to, when people cut back, they tend to cut back quite a bit. When things get better, they tend to buy less. So you can tell when the market's up, they tend to be up quite a bit. When the market's down, they tend to be down even more. And you see the opposite with utilities because people don't have as much flexibility to change their consumption in general because it's something that you need. And so it makes sense that the betas are also lower. When the economy goes down, people aren't able to cut as much on water or gas or electric.
Are you familiar with, at least in South Carolina, the Rate Stabilization Act? Are you familiar with that?
Yes.
Our acronyms, the PGA, the WNA, the Weather Normalization Adjustment. In general terms, what is the Rate Stabilization Act? What does it basically do? Do you know?
Well, my understanding, as far as I'm concerned, one of the very important aspects of it is that it has the band. If they earn less than 50 basis points in their authorized ROE, they're able to charge consumers and make up the difference. That's a very critical component of it in terms of relating to me in my testimony.
So what I think I just heard you say, or what you're saying the Rate Stabilization Act is or does, is if it's a 9.49 ROE that's approved, and when it's all said and done, it comes back as an actual 7.4. That difference, that margin, you do the math, you're better at this. But whatever it is, less than 2.
So I think you said 949 to 749, so 200 basis points, I think, or about, is what you're saying?
Yeah.
Okay.
Point being, what does that mean? What occurs?
If they unearn
If the approved return on equity by this commission is 9.49, and at the end of the year it comes back as 7.4, what does the Rate Stabilization Act do?
It enables them to go up and earn, I believe, up to 9%. That's my understanding. I don't think it goes back up to 9.50. Wouldn't go up to 9.49, but within 50 basis points, it would bring them up. So it would allow them to earn, instead of 9.49, they would earn, it would be 8.99, I think. Yeah. So that's a major protection of risk.
So do you say that increases their risk or decreases the risk?
Decreases.
And if it were 0.5 plus or minus either way, it's, it is what it is. Instead of 9.49, it comes back 8.99. And would you say, along the questions that Commissioner Williams asked, good questions, relative to the insurance, if you get out of this ban, or if they don't have enough money, or whatever it is, very good questions. But relative to the Rate Stabilization Act, the PGA and the WNA, weather normalization. In your opinion, do all three of those things make this entity less risky or more risky?
Having all of those in place make the company less risky, yes.
Would you consider that like insurance or not insurance?
Yeah, I could say it's a form of insurance. Yeah, absolutely.
If a storm happens?
Yes, in terms of the weather normalization. Yeah, I don't know exactly the mechanics of how it works, but that's my understanding. It would, in terms of the impact on weather, they would be protected.
And at the same time, Piedmont should get a good and fair ROE and everything else. Do you agree?
Absolutely. Yeah.
So the debate is, what is that?
Yeah.
Let me ask you something. And I apologize, I've forgotten the attorney's name. Jeffries, Mr. Jeffries. That happens a lot. But on the S&P Global table that he provided us, and I just kind of glanced at these. But as I look at the electric utilities column, the average ROE, and if you look at the gas utilities average ROE, and I can tell you what kind of caught my eye, but what do you see occurring from 1990 through 2021? What does it look like if we were talking about trends?
Declining.
In both of them or one of them?
Both of them has declined. The averages for electric and gas have both declined. There was one little kind of uptick. I don't know if you're getting to that much detail in 2016, but the general trend is down for both.
You know, I'm one of those for plotting things, scatter diagrams, drawing lines through them, and this kind of stuff. But, you know, just glancing at it, that was, you know, my first take. If I looked at this and tried to normalize it or whatever, it appears, and I think you agreed, that there appears to be on the electric side and gas side a general downward trend since 1990.
Yes.
All right, let me ask you this. Have you, in your analysis or whatever you did for this, have you looked at the company's approved ROEs over the past X number of years and their actual ROEs over the...
I have not. That would certainly be interesting. There are many questions to ask, and I've considered that. I think that would be interesting. I've done something, I think during the financial crisis, I looked not at ROEs, but earnings, and I was able to show that for many utilities, their earnings were not that impacted by the financial crisis. I've done some of that in the past, but I have not looked at these companies and compared authorized ROEs to actual ROEs, no.
Would you not think that would be interesting information to kind of have or look at or analyze? Just,
I think that would be interesting. Yeah, I think that would be helpful to see.
and I think you were here yesterday. I remember seeing your face.
I was here.
Probably yesterday, the day before, I don't know. And there was some discussion about unconventional and conventional.
Yeah.
And some discussion from me too, relative to proxy groups, numbers, looking at, and I didn't say what data sets we're using, but trying to get a statistical or valid number, I guess,
Yes.
relative to if we did a survey of the United States. I don't know how many people we have, 360 million. Would we, and whatever question we're going to ask, do you like water? Would we ask that question of all 360 million? Would it be 36 million? Would it be 360? Or what is the sample to get that plus or minus, say, 3%, 5%? Do you know that? Do you have a feel for statistics?
You mean what would be a sample size that we
Yes.
would be confident that we were getting a representative sample?
Yes.
That's a great question because it's different depending on what you're testing. And capital market data is one where people often make the mistake of saying, we have a large enough sample, we know what's going on. And that's led to a lot of funds going bankrupt because they have not had a large enough sample. I don't know if I jumped too far ahead, but if you're just talking about sample size, yes, I'm familiar with that, and it depends. If you're wanting to get certain types of maybe in certain situations, you need a larger sample size than others.
Well, you know, having heard a lot about Hope and Bluefield, which I think is good.
Yeah.
I'm glad everybody pays attention to that.
Mm-hmm.
And looking at proxy groups or thinking or talking about proxy groups, in your opinion, I guess based on what you do, trying to think, let's see. Is having a proxy group of 6 that are similar or called similar more important than still looking at the broader market and other utilities? I mean, I don't know the answer to that. I'm asking you. Is that more important?
Well, I think it's a great question. I think it's helpful to look at both, and that's why I do provide that in my testimony. I provide some of the return expectations of financial institutions for the overall market, so we're looking at that. I think that what I found through the years when I've spent considerable time in some proceedings debating over the proxy groups of which utilities to include, I found that to be to not produce that much of a difference, whether we debated whether it should be 6 or 7 or 8. So I'll still go through and check and make sure the companies are reasonable, but I found that to not make as big of a difference as other issues. So I generally, unless I can find a big reason, I tend to adopt the proxy group used by the company because then we have one less thing to spend time debating. So with that said, I have considered at times bringing in additional proxy groups to provide more information. I try in my testimony to bring a lot more information than just these 6. But I think looking at these 6 gas companies is valuable because we are dealing here with Piedmont with gas, and that does help us get a sense. And I think I'd mentioned a little bit earlier, I've been looking at some numbers recently, and it's been a little surprising that the cost of equity for gas has been coming down relative to electric and water in recent months. And that's consistent with the jump up in the stock price of gas distribution companies. So that's why it's valuable to be able to separate out gas, that group of 6. It'd be nice to have more gas distribution companies, but you need to have companies that are publicly traded and have investment grade and so forth. So I think we're kind of stuck with 6 there. When we go with electric, we can generally get more. It's usually between 20 and 26 companies. It's better. But I don't know if I'm answering your question.
Well, you probably answered as well as you could because I'm not real sure what my question was either.
Okay.
Because I guess if we were talking about sextuplets, you know, that makes some great studies. You're comparing very, very similar things.
Mm-hmm.
I guess is my concern, in your opinion, warranted, or I shouldn't be that concerned, of the idea that if we keep looking at the same things, the same six, not saying that that's a bad thing, but that it can be a self-fulfilling prophecy or self-perpetuating issue, that we're comparing the same things over and over and over and over. So that's where I kind of get into the conventional versus unconventional. When is unconventional? Answer that question, sir.
I think it is a concern it's reasonable to make sure we're getting some sense of what the cost of equity is without being circular. I think the real concern I have with kind of looking at other authorized returns to determine what an authorized return should be in a case. I think that's particularly problematic. We could, the good thing about when we look at, instead of looking at authorized returns of a products group, we look at the actual stock prices and market. At least we're seeing what investors, the decisions they're making. We're not just looking at authorized ROEs, but we're looking at investors' reaction to it. But I would agree, it'd be nice to also look outside of that, because investors, of course, are watching what authorized ROEs are and what authorized capital structures are. So to the degree that starts to impact it, yeah, it'd be nice also to consider companies outside of that group. The arguments I've heard often of circularity with results, I think are often not valid, because when we do look at the data, for example, I go up to the end of June 30th, the investors there, that data, the investors didn't know obviously what the outcome of this proceeding is. They could have been thinking about it as one, but even Piedmont's is a teeny piece of all of these companies. So how much is it impacting it? I think very little. But over time, it is I think it's a great question, and I've spoken with other people about that. It'd be nice to have proxy groups that are even really outside of regulated utilities. The problem with that is, and when witnesses bring that in, is you're bringing in Ford Motor Company or something, or I've seen even in some cases bringing in Ferrari. I mean, that's ridiculous, right? Because they're just a totally different kind of company, so you have to be very careful. I think it'd be a good exercise to try to find another group that's completely outside of this rate of return regulated area to help. You wouldn't have any circularity of any kind.
Well, keep in mind, I'm not the one that does this. That's up to you guys. So you guys have to decide that, or
I would agree. It should be helpful to be considered. Yeah.
And also, I think relative to I guess your discussion with Commissioner Williams. If I heard you correctly, you believe your band or range of ROEs and debt to equity ratio, you said you believe they are correct or good.
I do.
But, and you probably heard this asked yesterday of, I can't remember who I asked it of. I think maybe Mr. Korn and Padino. I don't know. Maybe Mr. O'Donnell. But along the lines of what Commissioner Williams asked is, what about the hardest word in the world for me to say, reasonableness. Yesterday, I think it was stated that, 8.9 or 9.0 would fall in that band of reasonableness. Mm-hmm. While that is outside of your ranges that you said, I really like mine, in essence. Although those are above your upper end of your range. Mm-hmm. Is 8.9 or 9.0 RE within a band of reasonableness to you? Or is that so far out you think the commission should not make that kind of decision? Or is that adequate for an incremental adjustment? That was kind of 3 or 4 questions in one, so good luck.
Okay. Yeah, I think my recommendation is to go within this range if the commission is saying, I just want to go completely with what investors' expectations are, and I believe that's what's consistent with Hope and Bluefield. Then this is the range, and I think going above it would be unreasonable. However, I do not feel, as I was saying to Commissioner Williams, I don't feel it as my role to. I'm not I'm not a commissioner. I believe that then gets into the commissioner's hands to weigh this evidence within everything else. If you're just asking on the rate of return portion what capital markets are saying and reasonableness, I think it going above my 874 is above what's reasonable. But I feel it's beyond my scope to determine all of the other pieces the commission will be considering.
That was a lot. So it's outside your band, but it could be, again, I don't want to put words in your mouth or try to trap you, because I'm not. But if an incremental step was made above yours and below 9.9, 9.49, is that a reasonable step to make?
I believe it is. What I would really hope as part of that would be an intention to move more and more towards what the actual market data is saying. And I think that would be I would very much understand that with the commission moving in that direction with caution and moving in this direction. I think that would be reasonable. I just have to say unreasonableness, and we have all these numbers, but we talked about subjectivity versus objectivity. I just kept thinking of this yesterday, and I feel like I just have to share this when we talk about reasonableness. I meet, as I mentioned, regularly with other people in major financial institutions who are quants and working with traders and various things, and just to really test what's going on. And when I mention a return of in the 9s or 10 for regulated utility, they almost fall off their chair. I mean, it's like a different universe that we're living in when we hear some of these results. So that just adds an extra layer of subjective confidence. When you see people who are trading and working on this and they fall off their chair 9.5%, like that is utopia. That's extra subjective feeling that this is reasonable.
Good enough. And I just have one more question because I've given up on trying to sort through my notes. You had mentioned earlier, and I can't remember who asked the question, but the results of, I think you said Mr. Bodino's model were very similar to yours.
Many of the results.
The results, you said. What do you mean by that? Explain that some to me.
Let me see. What I mean are his CAPM results and DCF results. So his DCF result, would you like me to provide where I say this in my SIR rebuttal?
I'd like you to provide anything you need to provide or want to provide to kind of answer that the best you can, because I'm trying to understand it.
I state on page 22 of my surrebuttal, I asked, Mr. Baldino uses 4 versions of DCF method. Do any of these versions provide a cost of equity result based on a reasonable growth rate component? And I say yes. Mr. Baldino also uses projected dividend growth as a growth component in 1 out of 4 versions of his DCF method. Although in principle I do not agree with Mr. Baldino's use of dividend growth projections as a growth component of his DCF, in this case it provides a reasonable cost of equity result of 8.1 to 8.35%. The result of my constant growth DCF method are 8.4% to 8.49%. So that's what I mean when I say some of his model results are reasonable. And it was the same with CAPM, some others were reasonable.
Okay. So you're saying as far as on that model, that particular model, the numbers he came up with were very similar to what you came up with.
For one of his 4 versions.
But ultimately, he came up with a different band or number on ROE because...
I would say the primary reason is he included the high CAPM result in the, I think it was 967 or about there, that was based on a risk premium that was not consistent with the research findings of his own source, Kroll, where you may recall yesterday we were talking about the supply side risk premium, where you account for the expanding price to earnings ratios. When you account for that, it's in the 8s, I believe 8.6 or something. I have to check. But so I don't know if you remove that, he comes much more in line within ranges for me. I don't know why you would include that higher number that's not consistent with the research. PE ratios cannot continue to expand like that, so it's unlikely that investors would think that's reasonable. So I think that's one of the big reasons he's able to get to his 9.3.
Understand. Give me 1 second while I just scan them.
Sure.
That's good enough. Thank you very much.
Okay. Thank you.
Appreciate it, Mr. Rothschild.
Madam Chair, I have one question.
Please go ahead, Commissioner Roy. I was just looking at the clock.
I-
Please go ahead.
Well, it looks like you have another commissioner questioning too, so
Do you mind waiting?
no, I don't mind.
Why don't we break for lunch and return at 2 o'clock? Thank you. We'll recess until 2 o'clock.